but it's a market that is looking at reasonable growth.
People feel like they have to put money to work.
Stay diversified, stay disciplined, and you get rewarded.
The market could get gut checked here from a momentum unwind.
Were it not for AI, this would be a very, very different story.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now. Coming into Tuesday, crude bounces, the U.S. striking Iranian vessels through the Strait of Hormuz. As the White House is calling it defensive, indicating talks are progressing well. It's leaving investors focused on a resolution and pushing equity futures higher, following the long weekend.
So what do we take away from this, given the fact that there have been actual strikes, yet at the same time we've been still talking about a ceasefire? It's that people want to believe that this has to resolve, and they're taking solace in the idea that it isn't escalating, even though there have been strikes, kinetic warfare. That said, when you take a look at the fine print, still so many questions, whether it's the nuclear, whether what's going to being agreed upon, whether the hard points are even being discussed, and what it means to reopen the strait with some payment, not necessarily a toll, but some payment that has to do with compensating Iran for safe passageway through the Strait of Hormuz.
Let's just park the price action just for a moment. The contradiction for everyone here, I think, is pretty clear. Talks are progressing well, apparently. Iran was laying mines, but we're reopening the Strait of Hormuz. Can you make sense of all of that
No,
this morning?
It's absolute confusion. It's also confusing when you hear the CENTCOM spokesperson in a number of statements to a number of news outlets basically say that this was defensive in nature. We want to hold on to the ongoing ceasefire. They are basically holding on to this ceasefire by a thread. And right now, when you see what is going on, going after the boats because the Iranians were laying mines and the Iranians going after F-35s, it doesn't sound like there's a ceasefire in place between Tehran and Washington.
The market had already moved on, and the market is itching to move on this Tuesday morning.
There is some validity to this, and I'll back the market for a hot second, saying that there were a couple of tankers that got through the Strait of Hormuz for the first time since February. You've seen a couple more trickle out. The fact that there hasn't been an escalation is making people have faith that both sides do not want to escalate, that they see it as more of a problem if there is a kinetic escalation. And people are looking at this and saying, feasibly, you have to have some sort of reopening at some point in the next couple of weeks. And that seems to be the excitement that people have. Is it clinging to too much hope? Yes. But that, I think, is what people are looking at.
All-time highs we're on track for this morning. Equity futures, a catch-up trade here, up by 0.6% on the S&P, on the Nasdaq, up by 1 full percentage point. Coming up this hour, we'll catch up with Steve Chevron of Federated as Wall Street looks past renewed Hormuz hostility. Sarah Kunst of Cleo Capital, as the OpenAI CEO, downplays the threat of a jobs apocalypse. And so on Desai, Franklin Templeton, as Kevin Walsh vows to lead an independent Federal Reserve. We begin this hour with the US launching fresh strikes on Iranian targets in the Strait of Hormuz. Bloomberg's Tyler Kendall joins us now from Washington. Tyler, you've got to explain where we are in these talks. Just where are we?
Well, John, at this point, it felt like that we ultimately had gotten signs of diplomatic progress over the weekend. You heard President Trump touting that they had good conversations towards a deal, but it does appear that the renewed fighting is now just underscoring how fragile this situation remains. Secretary of State Marco Rubio, speaking with reporters overnight, said that there have been multiple conversations, quote, back and forth, but that ultimately President Trump is only going to agree to a good deal or no deal at all, because this comes, as you have been outlining, on what appears to be renewed fighting between the two sides, as CENTCOM confirms that it conducted defensive military strikes near Iran's largest naval base, hitting multiple targets, including military launch sites, as well as these boats that were laying mines. And in response, we saw Iran engage U.S. drones and an F-35 fighter jet that entered into its airspace and is now threatening that we could see further retaliation for what it says was a U.S. violation of the ceasefire. That, of course, is raising the regional risk for our partners and our allies in the region that have been trying to urge this White House to reach a deal. We'll have to see how this ultimately develops from here, because the U.S. had been putting forward that we could be getting closer towards a memorandum of understanding. It appears that this would be a phased agreement where the ceasefire is extended, the Strait of Hormuz could be reopened, the U.S. lifts its naval blockade, but then we see those negotiations on Iran's nuclear program ultimately delayed. So, John, at this point, that's raising concerns even from some Republicans here in Washington that the White House could agree to this delayed deal for any sort of curbs when it comes to Iran's nuclear program and what happens to that stockpile of highly enriched uranium.
Tyler Kendall with the latest in the nation's capital. Tyler, thank you. Appreciate it. Here's the view on Wall Street this morning. Steve Chevron of Federated raising its year-end price target on the S&P to 8K, writing both sides of the Iran conflict need the war to end. When that happens, it will provide a favourable disinflationary tailwind, and the Warsh Fed will likely begin a new rate-cutting cycle. Steve joins us now for more. Steve, good morning, sir. It's good to see you. How important has this phrase been for you and the team? If it can't happen, it won't.
It's probably been the most successful trade over the last 20 years, right? If the global financial system is on the verge of collapse this weekend, it probably won't happen. If a deadly virus is going to keep us locked in our homes indefinitely, it probably won't happen. I think this is another one of those scenarios. The world can't allow the Strait of Hormuz to be closed indefinitely. China can't afford that. Asia can't afford it. Europe certainly can't afford it. Politically, it's not a winner in the United States. If it stays closed indefinitely, it threatens the very existence of the Iranian regime. And I think that's why the market is looking towards some deal here. There's enough noise. Yes, there's aggressive negotiating, to borrow a Star Wars phrase. But what you've got going on here, we think, is the beginning of the end. And I think what it belies, though, is the more important story for the markets, which is that we're seeing something happening with earnings that none of us have really seen in our careers. The fastest margin expansion we've ever seen. And I think that's what's driving the markets higher.
The outlook for earnings has got better, not worse.
Yes.
We've heard a lot of people communicate that on this programme. Has the risk-reward in equities improved, given the rally we've seen and the fact we're now basically at record highs?
Yeah, because I think it has. So a couple of things. I think, one, you've rallied so far, but you haven't brought all the market with you, right? So this has been a story. It was, again, the recovery off the lows was very much on tech, and the concerns earlier in the year about software disruption, but also whether or not you were throwing good money after bad with the hyperscalers. You're starting to see cash flows grow faster than capex, which has given you comfort. The oil-sensitive parts of the market haven't participated yet. And so if you do get some resolution here, which we think eventually you will, you can start to see a rebound in the consumer, some early cyclicals, maybe even real estate, although I think that's probably a little ways off. You got to get the rate cutting cycle. So we think there's more market return to come. We don't think this is played out.
Just to build on what John is talking about, you could say the mantra, if it can't happen, it won't, right? The other mantra is you start to get in when policymakers start to panic. And because everybody has been buying and trying to avoid some sort of downturn, you have not seen the panic coming from some of the executive branch. Does that give you a bit of concern that there isn't going to be as soon an end to this conflict?
No. I mean, it really does. I'll give you a couple of reasons why. I want to get back to this earnings story really quickly. We're seeing margins grow at a 9% clip on a year-over-year basis. That has only happened once, and it's been between 1995 and 1999. You're seeing cash flows of the hyperscalers grow faster than their capex, and this is the biggest capex boom since the railroad. Those are two incredibly bullish underlying fundamentals. That's one. Number two, we're talking about a Fed that's likely to stay on pause, right? We're not talking about some kind of massive rate hike cycle, and we think actually they'll cut once you get past the Strait. And so here's the deal. With Trump, and I think we've seen this now over 12 years, when he's getting close to a resolution, you see a little bit more disarray. You see that last grasp for that extra bit of leverage, and that's what the market thinks is happening here.
Why do you think this Warsh Fed so definitely is going to either remain on hold or start a cutting cycle when the market seems to A, disagree, and B, you're seeing inflation tick up, and C, you're seeing margins actually increase at the fastest pace ever, which is raising concerns about, are we even restrictive here?
So I think there's a couple of reasons why they'll be in that position. One, shelter prices continue to come down. Those are on a leg, and they're going to continue to be a disinflationary force. Two, energy prices, we haven't seen a big bleed through into core prices just yet. If we keep seeing oil prices here, you will. If this ends, we think you're going to see that pressure abate. So you're not going to have the energy price read-through excuse. And there are certainly parts of this economy, which has been our point for the last couple of years in criticism of the Powell Fed, whether it's low, middle-end consumers, small businesses, some of the cyclicals that are rate sensitive that have been under pressure now for 3 or 4 years. And so we think with those, and by the way, the other element here, too, is wage pressures have eased, right? there's still low unemployment, but we're not seeing the same kind of wage growth that we saw. There's not that wage price spiral. So we think, look, not an aggressive cutting into something that is, easy policy, but a move closer to a neutral rate, which is probably 2 or 3 cuts over the next 18 months, is probably where the Fed would have been absent Iran, and we think that's where it'll go after Iran.
Steve, on Iran, inevitably it will end, you say, and I'm totally there with you. But when? Because the Iranians seem to have a lot more patience, and for them it's existential in a different way than it is for this White House, which is also facing down midterm elections.
So I think from the market's perspective, it already has. I mean, that was the market's conclusion a month and a half ago. I'm not saying that that's right or not, but the market has moved on as this being a primary concern, just as it did with Russia-Ukraine in 2022, right? That war's still ongoing, but it's not driving markets the way that it was. I think in terms of the end, look, I'm of all the things I pretend to be an expert on, war is not one of them. But I will say this. I think one of 2 things is going to happen here. Either you are going to get to a negotiated settlement, or this re-escalates in a way that really threatens the existence of that Iranian regime. And it's not just the United States. At some point, other actors in the world, like Europe and Asia, just can't have that straight close. So this doesn't end well for them if they don't make a deal.
But from a market's perspective, at some point, do they need to go back and say, it's not over, we can't look past this?
Well, I think you certainly would get to that point faster in Europe. That's one of the reasons why we moved more underweight Europe, because, the poor Europeans, after the Russian gas strategy failed, they said, gee, let's go to Oman. That hasn't worked out well either. I think one of the reasons that you're seeing U.S. stocks, particularly growth stocks and EM stocks, do best is they're the least dependent on this, right? They either have the United States has a domestic energy supply, or you've got a secular story that is bigger than just an oil price. I think the more oil-sensitive parts of the economy, Europe, parts of Asia, they've already seen that, and that's why they're lagging. That's one of the reasons why we don't favor those parts of the world.
Steve, if we do see a resolution, does that change? Does that spark that rotation people are looking for?
I think it does in the U.S. I don't think it does for Europe. If you look at Europe, what's been interesting is that they underperformed when the conflict raged, and then they underperformed after the ceasefire was announced as well. And I think part of that is the stagflationary concerns there are more real, and I think they have some other issues. Whereas in the U.S., you saw kind of sharp rebounds. I do think in the U.S. what you'd see if we got resolution here is value would reassert itself like it did in the first part of the year. I think small caps would reassert themselves like they did in the first part of the year. So I think you would see broaden out in the U.S., but I like EM better than I do developed.
Saw some of that last week with the small caps to the equal weight. Steve, it's good to see you.
Great to be here.
Thank you, sir. Steve Chevron there of Federated. Equity futures this morning, we got a bounce from Friday's close, up by 0.7% on the S&P 500. With an update on stories worldwide, with your Bloomberg brief, Yahara has more. Hey, Yahara.
Good morning, John. The ceasefire between the U.S. and Iran looking fragile this morning. The U.S. and Israel striking Iranian vessels in the Strait of Hormuz overnight, while Iran's semi-official Tasnim news agency saying the Islamic Revolutionary Guard Corps shot down a U.S. drone and fired at an American fighter jet in Iranian airspace. Russia is advising the U.S. to evacuate its citizens and diplomats from Ukraine's capital. The Interfax news agency says Foreign Minister Sergei Lavrov told Secretary of State Marco Rubio that Russia is launching systematic and consistent strikes on Kyiv. And we are seeing Ferrari shares plunging in Milan after critics blasted the look of its first fully electric vehicle, the $640,000 Luce. The 4-door, 5-seat EV drew negative reviews from analysts and those on social media, marking an early setback for Ferrari's controversial push into EVs. That's your Bloomberg brief. John.
Yahara, thank you. Thank you very much. The Luce sending Ferrari enthusiasts to a very dark place over the weekend. The irony not lost on anyone.
Yeah, okay, yes, but I have to say, I admire the craft here, and I admire
the craft. Okay,
not for $600,000.
Please tell us more, Abramowicz.
Well, I mean, I'll hold some of my. I'm sure I'm just going to get iron. The engine, the way that they went trying to create that sort of visceral response that people have to the engine.
Can't wait for the Ferro rant.
They went and tried to amplify the noise of the engine, even though it was electric, to try to get that sort of
she's
revving
grasping at
sound.
straws this morning.
There is a bucket somewhere, and in that bucket is cappuccinos after lunch, cutting up your spaghetti
after
and
10
putting
a.m.
ketchup on pizza, okay? And that belongs in that bucket.
Okay, wow,
right.
okay, how do you really feel?
More on that a little bit later. Up next on the programme, that's the tease. Renewed fighting with Iran.
These incredible men and women gave their lives to ensure that the world's #1 state sponsor of terror will never have a nuclear weapon. Oh, and they won't. They will never have a nuclear weapon.
Stephen Cook of the Council on Foreign Relations joins us next, live from New York City this morning. Good morning. Live from New York City, welcome back to the program. A light slate of economic data for the week ahead, a shortened trading week. The main event, though, later on the week, PCE data dropping on Thursday. Look out for that. Read on the consumer as well at the same time. Earnings from Best Buy, Costco, Dollar Tree throughout the week. We'll report on some of those names for you as the week rolls on. Let's get to the price action for you. Equity futures, of course, pricing off Friday's close. A catch-up trade here stateside. Equity futures positive by 0.7% on the S&P, on the NASDAQ up by 1 percentage point. You see this move reflected in the bond market as well. 2s, 10s, 30s, yields pulling back. 10s now sub 450 at 449. WTI priced off Friday's close still looks like this. Down on the session by 4 percentage points versus Friday. If you price it off yesterday, which is what we can do with Brent, this price is in maybe just a touch of escalation overnight. Brent crude up by about 3 percentage points at 98.88. There is some escalation. At the same time, the market on net seems to be encouraged by the comments over the weekend.
The U.S. coming out and saying that what it was doing was simply retaliating and it was defensive strikes against Iran. Over the weekend, however, both sides talking about how a deal is getting reached, how Pakistan was getting involved, Qatar was getting involved. Interesting to see some of the other regional allies of the United States being involved in some of these discussions. Everyone's trying to get a deal, and reopening the strait, as we heard from Marco Rubio, is non-negotiable.
Brent crude this morning higher by 2.9%. Under surveillance this morning, renewed fighting with Iran.
These incredible men and women gave their lives to ensure that the world's #1 state sponsor of terror will never have a nuclear weapon. Oh, and they won't. They will never have a nuclear weapon. We're having victories all over the place, more than we've had in many, many decades.
So here's the latest this morning. The US and Iran clashing near the Strait of Hormuz, even as both sides tout progress on a peace deal. Stephen Cook of the Council on Foreign Relations writing the Iranians will not give up their right to enrich uranium, and they want management over the Strait of Hormuz. Stephen joins us now for more. Stephen, welcome to the program. Let's run with those 2 points. They want to carry on, and they want the right to enrich uranium, and they want to manage the Strait of Hormuz. How do we strike a deal with them not backing away from those two things?
Well, that's exactly the point, is that the Iranians have remained firm that they have a right to enrich uranium. They have not given on that at all. Every time the president has said that the Iranians have agreed to something along these lines, the Iranians contradict those statements. It seems quite unlikely that they will give up their right to enrich. There might be some way to fudge a situation in which they enrich to lower levels than before. They move enriched uranium outside the country, but they will maintain that right to enrich. And then when it comes to the Strait of Hormuz, luckily for them, the president launched a war on February 28th, and they now have control or partial control over the Strait of Hormuz in a way that they never could have dreamed of before. It seems unlikely that they're going to give it up. They said that there would be no tolling of the Strait of Hormuz, but there certainly would be fees for service for shipping going through the strait. So I don't think we're as close as the president and others would suggest, without either the president capitulating or the Iranians capitulating, and it doesn't strike me that the Iranians are in a position or willing to capitulate.
So basically, Steve, the same thing, just different branding. Would you assess that this morning we are still in a ceasefire?
Well, I think the president and others would like you to believe that we're still in a ceasefire, but obviously the United States and Iran are on a hair trigger here. The Iranians apparently threatened U.S. forces and even fired on U.S. forces, and the United States responded. But this is not a return to the kind of high-intensity combat that we saw throughout March. Clearly, the president is shying away from a major escalation and is looking for a diplomatic way out. But the Iranians aren't going to let him do that. They have an enormous amount of patience, and they have inflicted a lot of pain on their population, and they're willing to continue to inflict that pain in order to push the president into a humiliating capitulation.
What was interesting over the weekend is in one very long Truth Social post, the president talked about Saudi Arabia and Qatar and how these countries should be joining the Abraham Accords. Is there any room for that to wrap up this conflict?
It seems like the president is aware of the criticism of the deal that's on the table, at least what we believe the deal on the table might be, and is trying to make it look better by saying that it will simultaneously come with an expansion of the Abraham Accords. But the Saudis have held firm and said that they will not normalize relations with Israel until there is an irreversible path towards a Palestinian state. The Qataris have said that they will deal with the Israelis, but only in terms of resolving the Israeli-Palestinian conflict. So it doesn't seem to me that normalization is actually on the table. The president is just trying to sell this deal in a way that will make it more palatable for the Republicans in the Senate and others. But I don't think anybody really believes this normalization is on the table.
Stephen, you said they're more palatable to Republicans. This is what's interesting to me. Is that part of the issue? Is it more palatable to Israel? How much is the break between both President Trump and the Republicans in his party, as well as Netanyahu in Israel?
Well, it seems that there's a rather significant break between Israel and the United States. That's to suggest that the Prime Minister has come to the conclusion that there's really nothing that he can do with regard to the president's positions on Iran, and that Israel will have to take matters into its own hands. It has consistently said that whatever ceasefire the United States or whatever agreement the United States and Iran come up with, Israel will not necessarily be a party to it with regard to the Lebanese front and Hezbollah. The Israelis have been taking a lot of fire from Hezbollah. Hezbollah has been using these wire-guided drones to which the Israelis have very little defense. So you're seeing Israeli soldiers killed day in and day out. The Israelis just can't give it up there. When it comes to the Republicans in the Senate, there's been a lot of criticism from those senators because the deal looks like it gives the Iranians very significant sanctions relief, the ability to sell oil, which removes a significant amount of leverage when it comes to trying to press them to end their nuclear program.
The more you talk, Stephen, the more I'm at a sort of cognitive dissonance between the two Steves this morning. We had one Steve coming on saying if it can't happen, it won't. It's not going to be an issue in a couple of months. Everybody needs the Strait of Hormuz open. Then you come on and you're saying essentially that it seems like we're pretty far apart. How do you reconcile where the market is and where negotiators are?
Well, I heard your interview before I came on, and I think this is something that's been happening in the markets from the very beginning, is that there is a belief that there's some magic formula that's going to open the Strait of Hormuz. I was on with you all in April at the time of the IMF World Bank meetings, and I think there was an expectation that the Strait would be open in a matter of days. I hated to throw cold water on that at the time, but it was going to be months before this issue is resolved. Perhaps the president will, as a result of these strikes, will have instilled a little bit of flexibility in the Iranians, but so far the Iranians are hanging quite tough.
We were told that Friday, April 17th, the Friday off that week down in Washington, D.C., the Strait would reopen, and then, Lisa, the Strait did not reopen that weekend at all.
What's fascinating is we've gotten these head fakes again and again and again. And instead of being benumbed by them, markets welcome each one. Oh, good. It's nice talk that we're going to get. Let's breathe some life into it. And it's because of what the first Steve said, which is if it can't happen, it won't. And that's been the winning trade.
Stephen Kirk of the Council on Foreign Relations. Stephen, good to see you, sir. Thank you very much. The pressure's not coming from the market, that's for sure. Equities close to all-time highs and crude backing away.
The only issue I have was with the idea that if it can't happen, it won't, was that's what everyone in Washington, D.C. thought about the Strait of Hormuz being closed for even this long, that the Iranians would never go there. That's what everyone thought about Russia's invasion of Ukraine. They're too tied into Germany, the Europeans, the global economy, that they won't do it. Guess what? Sometimes in geopolitics, they're thinking about this a lot differently than the markets are or even this White House are.
And yet the stock price and the stock market still goes up and to the right on every chart I'm looking at over that period.
And people say it's the earnings. People say, look, we've been able to exist this long. And you know what? We're going to close our eyes, la, 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 and buy. I'll avoid some of the oil-sensitive stocks.
Up next, we'll catch up with Sarah Kunst of Cleo Capital as top CEOs downplay the risk of an AI jobs apocalypse. Plus, we'll close our eyes when we look at the latest car coming out of Italy.
I'm in a bucket with cappuccino and cut up spaghetti.
By 3% from New York. You're watching Bloomberg TV. Three-day rally on the S&P 500 leading to an 8-week winning run on the S&P this morning. Futures bouncing by 0.75% on the S&P. On the Nasdaq, up by more than 1 percentage point. Playing catch-up following the long weekend. In the bond market, same story. Yields down across the curve. 2s, 10s and 30s. 2s down 6 basis points to 4.05%. Priced off this move on WTI, pricing off Friday's close. WTI this morning down by around 5% to 91. Let's call it 92. Just about.
Because people uttered the word ceasefire once again and everyone got very excited. There was a sense that we were getting close. It was coming from both sides. We have seen an escalation in some of the violence. That said, it seems like there is some oil and some natural gas getting through the strait, and there have been increasing reports of that happening. So somebody's saying, how closed is the strait? It is, getting a little bit open. I'm trying to reconcile the two Steves. I'm not doing a very good job.
I hear you, but I also hear a lot of people who are confused. Told repeatedly over the weekend that we're closer to a deal, that will reopen the Strait of Hormuz, and at the same time, we're bombing vessels who are laying mines through the Strait of Hormuz that are about to reopen to allow the free flow of energy in the Middle East.
It feels like the most extreme version of a carrot and stick approach. The talk sounds like they are moving forward, maybe baby steps, but moving forward, and we saw that throughout the entire weekend. But then what we actually saw on the ground, not what people are talking about, what they're doing, is that we are seeing kinetic warfare back again, even though they are saying that this is defensive in nature and they are clinging on to this idea that this ceasefire can hold.
The only way to make sense of this, really, is that Iran's version of this deal, this free flow of energy through the Strait of Hormuz, is through the path that they want everyone to go through, which is why the mines are being laid. Now, if the US has signed up for that, there's going to be a lot of questions about the kind of deal that are about to sign.
Yeah, which is the reason why Republicans have really been pushing back and saying, hold on a second, this allows Iran to have quite a bit of power. If it's too confusing, it can't happen. Just look at earnings, John. Just look at earnings.
Earnings are great.
They're good.
Stocks are up and to the right.
So what's the problem?
All-time highs. There is no problem.
Clearly.
Equity futures this morning up by 0.8%. No problem in this equity market, that's for sure. Let's get you some single names. Some problems in Italy, some morning movers. Yahara has more. Hey, Yahara.
Exactly, John. And for that reason, we are seeing Ferrari shares plunging over in Milan, down 6.3% after it unveiled its first fully electric vehicle. And the early reviews are pretty brutal for the $640,000 car. Looking through analysts' notes, one saying that it is far worse than he expected, and even calling it a cross between a Tesla Model 3 and a Honda Accord EV. Not something you want to hear if you are the iconic Ferrari brand. Turning to Dell, those shares are rising some 4% in the pre-market, headed for a fourth straight day of gains as investors lean into the AI infrastructure trade just ahead of its earnings on a Thursday. And part of the optimism coming from strong results from Lenovo on Friday, fueling bets that Dell could once again raise its guidance on strong AI server demand. And we end on Sweet Green. The salad maker shares are up 7.5% in the pre-market after jumping nearly 9% in the last session on an upgrade by analysts over at JP Morgan to overweight, saying the company is focusing less on robotics and more on menu items that people actually want, pointing to the success of their new wraps. That's John.
Yahara, thank you. Appreciate it. Thanks for the update. More from Yahara later this hour. On our radar this morning, the US holding firm on its demands for Iran. The Secretary of State, Marco Rubio, saying the country must reopen the Strait of Hormuz.
They're going to be open one way or the other. So they need to be open. What's happening there is unlawful. It's illegal. It's unsustainable for the world. It's unacceptable. The straits need to be open, unimpeded, without tolls. And obviously that needs to happen immediately as soon as anything's agreed to.
Rubio adding it could take a few days to reach a deal following fresh US strikes in southern Iran. Elsewhere, China announcing new restrictions on overseas travel for its top AI talent. Sources telling us here at Bloomberg that professionals for firms including Alibaba and DeepSeek are among those who now need additional approval before leaving the country. And finally, the Goldman boss, David Solomon, downplaying AI's impact on employment. Solomon writing in the New York Times that while artificial intelligence will create disruptions, the US will see a revival in productivity rather than a job apocalypse.
To me, it was interesting that he wrote this in the first place. CEOs are trying to get out front of a message that's getting increasingly unpalatable to college students and, frankly, to rank and file across the country, talking about how, yes, this could be problematic given some of the transition that we saw during the Industrial Revolution, but then going on to make the argument that you made last week, John, which is that overall the quality of life has improved going back to the 50s or the 40s or the 30s, and can't we just lean into that? And down the line, there'll be more jobs that get created. Whether or not this is true, he even put a caveat in there. If this isn't true, we should probably retrain people pretty quickly. But it gives you a sense of where the PR push is right now, given the fact that all of the corporate executives are investing in this. They say this is the future. Now they have to get everybody on board.
It's interesting that he also wrote this at a time when he just gave a speech about this. It doesn't seem like his house EDM track that he played for the Wharton Business School students actually worked, because it was dead silence after he played that at that commencement speech. What I found interesting about this opinion piece is he talks about this potential greater speed public policy must respond. And right now what you see is a deregulatory push in Washington, D.C. when it comes to AI. And at some point, there is going to have to be a policy response if you're getting the types of reactions you're getting at college campuses.
It's an interesting essay. There's a line in it that jumped off the page for me that when I was a first-year banking analyst, something as simple as making a graph of a stock's performance used to take 6 hours. Efficiency. But is this about increasing efficiency or is it about replacement? And that's the debate that everyone's having right now. Cost is going to be a big factor in all of that. There's also belief. What do you believe? What do you believe is true coming out of the C-suite right now, particularly after the comments of Bill Winters of Standard Chartered just a week ago? Is that the real version of the actual conversation taking place on Wall Street? And is this the version that maybe they'll be pushing in the months and years to come?
Especially as their staff contracts and as you start to see greater efficiencies there. Yes, there might be more people working in data centers to build them and construct them, but there's not exactly crossover. And that raises, again, the point of retraining and how you sort of adapt people's who are accustomed to certain lifestyles of a certain paycheck moving elsewhere. You're going to hear more CEOs talking about this. The real issue is we just don't know. And when you talk to a lot of them, they don't know either, at least when they're not on a podium.
Let's build on this. It is the great debate on AI unemployment. The OpenAI CEO, Sam Altman, downplaying a jobs apocalypse. The Anthropic co-founder, Chris Olah, telling the Vatican AI could replace labour on a, quote, very large scale. Sarah Kunst of Cleo Capital writing, we can assume that for any Anthropic position, OpenAI will have the opposite. The reality is somewhere in the middle. Sarah joins us now for more. Sarah, welcome to the programme. You heard us talk about that essay from David Solomon of Goldman Sachs. In that piece, he talks about two different versions, either a jobs apocalypse or a massive increase in efficiency that we all benefit from. Sarah, how do you see things playing out?
I think a little bit of both. There will be, and we're seeing sort of this white collar recession at a time where cost of living is also sky high. And so not having a job is a much more expensive proposition than it used to be, or being underemployed is a much more expensive proposition than it used to be. And so there's a lot of nervousness, and there are a lot of jobs that do seem like they are trending towards we need less of them, whether that's sort of the paralegals, the front end web developers of the world, what has long been thought in sort of this last generation as a solid kind of entry-level white-collar job is disappearing.
That said, to the point that John was making earlier, we are seeing a real transition right now. We are seeing this sense that people are getting replaced, and this time could be different. And this is what people talk about, that you're replacing true intelligence rather than, say, just functionality when it comes to Excel spreadsheets or Google searches. Is this time different when it comes to the revolution in jobs?
I think that we're replacing the ability to sort of do things in an automated way. And we have built a lot of our industries on having people who sit there and do that sort of same thinking again and again and again. I don't think that AI replaces true intelligence, creativity, but there's also a lot of jobs that don't necessarily require that day to day. And so what do we do with those people, especially in an economy like the US, where we don't have, single payer healthcare or a huge sort of way to give a social safety net at scale to working age people?
How much are discussions around part of the white-collar workforce going away, justifying the spend that a lot of CEOs are making on this technology, and frankly justifying the roadshows that the OpenAIs and Anthropics have out there for IPOs?
Those are two super different questions, right? Because we've seen a bunch of research that comes out that says when you put AI into a company, a lot of times you're not necessarily getting a tremendous amount of gain overall. We know that there are companies where engineers are being incentivized by a leaderboard of how many tokens they use. So they're building little vibe coding apps to just sort of burn tokens. They're making videos of their mom every day or something just to kind of burn all of that to sort of be managed by that metric. That's not efficient. That's not adding efficiency. That's not great spend. However, those tokens being used is very, very, very good for the Anthropics, for the AIs, for the open AIs, and even the SpaceXs who want to IPO based on that story.
Sarah, all those three names, you say it's unlikely all three will find a warm reception. Who's not going to find a warm reception when they IPO?
I think it depends on timing. I suspect that there are crazy levels of internal discussions happening right now of, do you want to be the first? Do you want to be the middle? Do you want to be the last? Last to IPO, generally, that can be a really tough position because people have kind of placed their bets. The hubris has died down. You start to get the doubts, and you never know what's going to happen in the rest of the world. We live in very interesting times, but first can be a little scary too if you mistime it. And it's hard to time being the middle when you don't know when the other two guys are going. And so I suspect there's a lot of jockeying behind the scenes to figure out when should we IPO. And I would not be surprised to see them do it a little bit kind of on a very short notice where they file, they go because the window feels open, the moment feels right. It's a little bit like taking off in a spaceship.
Sarah, though, when I'm looking through your notes, it does sound like you don't really love OpenAI. You're a little bit scathing on this company. Why?
I think that we've seen that this is a bit of a ship of Theseus, right? Most of those initial founding technical co-founders are now at Anthropic, or they have, in the case of Ilya and some of those other guys, their own sort of neo labs, right? And so the technological excellence that built this company is no longer there. We've found out a lot about Sam Altman over the last few years. It's not normal to get fired or attempted to be fired from every single job you've ever had. And so it's a little bit concerning when you look at that track record that we now know and say, yikes, why doesn't anybody like this guy? Why don't people stick around? Those are relevant questions for the CEO of a publicly traded company, except he's also pretty, indifferent on whether or not he actually wants to be the CEO of a publicly traded company. So if you are building your hopes around Sam, one, why do you think this time is different? And two, is he actually going to stick around? And I think those are both huge, although slightly opposite questions.
Some of those questions were asked of Mark Zuckerberg, though, Sarah. I remember the IPO, the roadshow when he was wearing the hoodie. A lot of people were asking questions about whether this was the right guy to run a public company, questions about the origins of the platform to begin with back in his days at Harvard. How is that any different to Sam Altman over at OpenAI?
I mean, look, I think that being a little bit sketchy when you are a 19-year-old and then going on to build a company that, remember at the time, right, we had Sheryl Sandberg, we had all of these sort of adults in the room, as we sometimes call them in venture, who did have a lot of that deep corporate experience that people trusted because it felt like, hey, maybe Mark's not necessarily the guy for the job. And those people broadly had a lot of sticking power. Whereas you look at Sam and you say, okay, this is somebody who's in midlife, mid-career. This isn't sort of a youthful indiscretion. This is just kind of who he's been. And he has a really hard time keeping executives. That revolving door of OpenAI is moving fast.
Fair point, Sarah. Appreciate it. Thank you. Sarah Kunst there of Cleo Capital on OpenAI versus Anthropic, and two very different visions of the future. Let's give you an update on stories worldwide this morning with your Bloomberg brief. Yahara has more. Hey, Yahara.
Hi, John. The head of the WHO will visit the Ebola-hit Democratic Republic of Congo today. The number of confirmed deaths in the country topping 200, raising fears of a wider regional spread. A Samsung labor union is trying to stop a vote on a bonus plan that would give nearly $27 billion to the company's chip workers. The union says the deal unfairly favors Samsung's semiconductor division over other employees. And in sports, the Knicks are heading back to the NBA Finals for the first time since 1999. New York sweeping the Cleveland Cavaliers in their 11th straight playoff win. They'll be taking on either Oklahoma City or San Antonio in the finals, which tip off on June 3rd. That's your Bloomberg Brief. John.
Yahara, thank you. Thank you for the update. They just don't lose.
It's amazing. They literally just don't lose. And what's so great about this is that the Spurs and Oklahoma are now 2 for 2. So they're just going to exhaust themselves while the Knicks get to rest, get to practice, stay focused, locked in.
Show us the money. What's the price for a ticket?
Oh, my God. One ticket.
What's the price? Cheapest price?
Something a little bit north of $3,000. That's nosebleeds. One ticket is going for more than $500,000. If
World
anyone
Cup.
needs a +1, I am available.
The World Cup looks good value.
I mean,
right
honestly,
now,
that looks
right?
like a nosebleed seat for the World Cup. And frankly, they've done the World Cup before 1999, or since 1999.
Up next on the program, backing Fed independence.
Honestly, I really mean this. This is not said in any other way. I want Kevin to be totally independent. I want him to be independent and just do a great job.
Up next, we'll catch up with Desai of Franklin Templeton from New York City. This is Bloomberg Surveillance. Equity futures on the S&P 500 positive here by 0.7%, on the Nasdaq 100 up by more than 1 percentage point this morning. After closing for the long weekend, we reopen with Russell futures higher by more than 1 percentage point. In the bond market, yields pulling back, particularly at the front end of the curve. We're down by 7 basis points on twos to 4.05%. Under surveillance this morning, backing Fed independence.
Kevin will restore confidence in the Fed, which is so important. Honestly, I really mean this. This is not said in any other way. I want Kevin to be totally independent. I want him to be independent and just do a great job. Don't look at me. Don't look at anybody. Just do your own thing and do a great job.
So here's the latest this morning. Fed Chair Kevin Walsh preparing for his first full week as the head of the FOMC. President Donald Trump easing his calls for interest rate cuts as traders raise bets for a possible rate hike. Sonal Desai, Franklin Templeton writing, with the energy shock feeding into headline inflation, rate cuts are off the table. Sonal joins us now for more. Sonal, welcome to the programme. If rate cuts are off the table, are rate hikes on the table?
So, hi, John. Thanks for having me here. But I would say that rate hikes are on the table in certain circumstances. I think 4% headline inflation at this point is almost baked in the cake for this year, just because of where oil prices are and the elasticities associated with it. But I think if we were to see headline inflation actually start veering not towards 4, but closer to 5, I think rate hikes are on the table. I don't think that happens this year, by the way.
It was funny to know. When do you think that will happen?
If it happens, it depends on how long these oil prices remain in place. And if it were to happen, it would be next year, I think. This year, I think that even if the conflict were to resolve in the next week or 2 weeks, I still don't think that oil prices come down significantly below something like, say, 80. And that's enough to get headline up towards 4.
Sonal, an increasing number of people are questioning whether we actually are at neutral or above neutral. Michael Darda from Roth Capital Partners over the weekend. What if the Fed is actually below neutral? Matt Lazzetti of Deutsche Bank coming out with a piece called Overinsured, where he talked about the 175 basis points of rate cuts, saying maybe they went too far. How much are you sympathetic with these views?
Well, I've been saying that the neutral rate is closer to 4 than to 3 for about 2 or 3 years now. So I'm happy to see more people coming around to this view. But I completely agree. I think Jay Powell has described policy repeatedly as being moderately contractionary. And I would see it as being moderately expansionary. And I think 4% is probably closer to where neutral is. Between productivity growth and the Fed's own inflation target, I don't think you get to 3%.
If that's the case, Sonal, then you might want to buy the long end of the yield curve if you believe that the Fed is actually going to respond to some of this pressure with a rate hike. Is the signal that you're taking from the market that there isn't a whole lot of faith that there will be some sort of hiking cycle, even if inflation remains elevated?
So here's the thing. Inflation has been elevated. For 3 years now, the Fed has been 50% above its inflation target, and the Fed has cut, over that period of time, close to 200 basis points. And therefore, we actually have a very dovish Fed. And I think the market is perhaps coming around to that viewpoint, regardless of who the Fed chair is. I think we have a very, very dovish Fed. We've always had one. And I would say that if we look forward, I don't think the market currently is pricing in realistically what long-end yields would be. I think 475.5 is probably closer to fair value. I think this is not yet the time to go all in on long end yields. I think we're going to range trade a little bit, but the drift over the next several years, I would say, is probably upwards. It's not downwards.
So no, it's a great point, because many people probably argue that actually Jay Powell, who was another Trump appointee, could be even seen historically more dovish than Kevin Warsh. Kevin Warsh, when he was signing in his swearing in on Friday and then also gave a little bit of a speech, said he's going to lead, quote, with energy and purpose, just the way Chairman Greenspan did. Can you glean out what kind of Warsh Fed we're going to see?
I think an orthodox one. I hope to see an orthodox one. It's been close to 20 years we've had completely unorthodox policy from the Fed. The first go-to is quantitative easing. That is very, very unorthodox monetary policy. The Fed should not be engaging in the long end of the yield curve outside true crisis. And it is true that they've come in several times when there was a crisis, but they remained in for much longer than any crisis would indicate they should. Therefore, I think if I think about Greenspan's Fed tried to push markets into valuing risk more appropriately. The Fed did not bail us out. If long-end yields were surprisingly low over the Greenspan era, I think it had a lot more to do with what was going on in China, petrodollars, the savings glut. And since the crisis, the global financial crisis, what we've actually seen is a Fed which is almost led by markets. Everything that's gone on the long end of the yield curve seems to be driven less by the economy and much, much more by Fed action, intervention, in a part of the yield curve it actually shouldn't be present in.
Some people might say the toothpaste is out of the tube. Do you see it differently? Do you think we can go back to where we used to be?
No, I don't think we can go all the way back near term, but I do think over the next 4 years, I don't think Kevin Warsh is coming in and I don't see him shaking up markets by immediately trying to reduce the size of the Fed balance sheet. But over the next 4 years, I do think we'll see a more sustained move in that direction, in the direction of reducing the size of the Fed balance sheet. It is enormous. I don't think that he's looking for the financial instability that an overnight return to...
But let's say he goes in that direction. I'm not saying we get back to that place, but let's say he goes in that direction. Do you want to own those assets on that balance sheet?
Eventually, yes. But before that, we're only talking about monetary policy in isolation. We need to see what's going on with fiscal policy here. And that's another piece of this puzzle, and it's not a good one. And that's a part of the reason that I would not be jumping in to buy long-end bonds at this point. I think between inflation, between a return to hopefully more orthodox monetary policy and a continued fiscal profligacy in the US, I don't see a reason to go all in there and own long-end bonds. I think you could opportunistically go in and come out, but I think over a medium term, long-end yields are going higher.
Snow, thank you. Appreciate it, as always. Snow Desai there, Franklin Templeton. I was going to say earlier in the conversation, it's funny that we were all focused on the White House on Friday, but the real headlines of the Federal Reserve were made in Frankfurt with Governor Waller really pushing back against the easing bias over the Federal Reserve.
Seems to join the dissents, which a lot of people are taking as just confirmation that the move away from the easing bias. That said, this is a dovish Fed. And how much do they have to be based on the deficit versus GDP? And that is what a lot of people are focusing on.
Incredibly dovish Fed.
Correct.
Before Kevin Warsh even got there.
Correct.
Up next on the programme, Leslie Marks of Mackenzie Investments, Henrietta Treyz of Veda Partners, Calvin Say of BNP Paribas, and the former New York Fed President Bill Dudley with some things to say about where rates are right now. From New York City, the second hour of Bloomberg Surveillance. Up next.
We're not seeing recession, though there is this tale of two economies.
We're in this environment of fiscal activism and economic nationalism.
We've backed out 3 rate cuts and added 2 rate hikes.
I think that the Fed will not hike rates this year.
The market's really having to discount this backdrop in which the economy is stronger than expected.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The second hour of Bloomberg Surveillance starts right now. In your price action, your scores look like this. Close to all-time highs on the S&P 500 following 3 days of gains. Just short of those levels this morning. Following a 3-day closure of this market, we bounced by 0.7% on the S&P. On the Nasdaq, up by 1 full percentage point. In the bond market, yields backing away from multi-decade highs. At the long end of the curve, down by 6 basis points. At the front end of the curve, down by 7. Queuing off this in the commodity market. WTI this morning pricing off Friday's close on net, still lower by 5%. With the escalation we saw overnight, you see a bounce in Brent crude, but still the focus of this market, a resolution to this conflict.
And what are the conclusions if we get some sort of resolution? This is what I find interesting. People believe that inflation will fall back down, that the Fed will be able to cut rates once again, that earnings will rebound in some of the less loved sectors, which is the reason why you saw equal weight outperform last week for the first time in a while. And you saw declines actually on some of the Magnificent Seven names. And you will get back to where we were before. You could focus on earnings again and ignore what's going on. That's where I'm actually curious about analyzing, because I cannot analyze what's going on with Iran and the United States.
I know the market wants to move on and focus on earnings, but you have to look at, to understand what's going on in this conflict, you have to look at not what the president or the Iranians are saying, but what they are doing. And what we see them doing is actually what they say is defensive to hold on to the ceasefire, but it is more kinetic warfare. They are going after the speedboats that the Iranians were using to drop mines, and the Iranians are going back at the Americans going after F-35s. So for me, this doesn't look anything like a ceasefire. We are seeing some kinetic movement in the region, and I think this shows that they are still a long way from reopening the strait and then getting to the negotiating table to talk about nuclear.
Energy coming in just a bit, but relative to last year, much higher. So looking ahead to the data later this week, PCE on Thursday, we're expecting a number closer to 4%. That's almost a full percentage point higher than it was just a few months ago. We've seen a real bounce in inflation data and the outlook for higher prices.
And a key question for a lot of economists is how sticky this will be, because if you take a look at a recent Oxford economic study, they talk about how it can take 2 years for this shock to work itself through the market. Is there a dissonance between how much profit margins are increasing at companies, the earnings that everyone is cheering, and the potential for there to be stickiness in some of this inflation? A lot of people come here and say, absolutely not, Lisa. Look at what we're seeing in housing. Look at what we're seeing with wages. It's all great when you look at the inflation front. Other people saying, take a look at what's actually happening, and maybe we're not restrictive at all. Maybe this is actually easy in terms of monetary policy.
It's all great for the bad reasons, you know.
But exactly. People aren't getting paid.
Great reasons.
I mean, it sort of, again, goes back to the labor question, but I'm going to get off that.
Did you see UMich on Friday?
I did.
Let's really get Bramo going.
Terrible. Well, okay, and Kevin Hassett came out and said, this is a political poll, political sentiment, da-da-da-da-da. That said, even if it is political, the fact that some people are feeling the worst that they've ever felt, and it is a contingent of the population, is it because of AI? Is it because they don't like President Trump's policies? Whatever it is, some people are feeling bad.
Headline index, record low. 5 to 10 year inflation outlook, whatever that's worth, climbing higher to close to 4%, and more worries that higher prices will hit personal finances. To your point, whether you believe that's a political poll or not, you have to ask yourself, will that shape behavior in this economy for a certain cohort of people in this economy?
Also, will it shape how people go out and vote? Even though this maybe is political, we see in this country, elections are won by the independents in the middle, that swing. And this does not, a survey like this with consumer sentiment dropping to brand new lows does not bode well for this White House.
Futures this morning positive by 0.7%. That's your bounce on the S&P 500. Coming up this hour, we'll catch up with Leslie Marks of Mackenzie Investments. As stocks notch an 8-week winning run, we'll speak to Henderson Treyz of Veda Partners as the US and Iran exchange fire. And we'll catch up with the New York Fed President, the former New York Fed President, Bill Dudley, on a newly minted Fed Chair Kevin Warsh. We begin this hour with stocks on track for a 4th consecutive day of gains. Leslie Marks of Mackenzie Investments writing, we have a neutral view on equities. Equities just may need to consolidate here for a bit before their next move higher. Leslie joins us now for more. Leslie, good morning.
Good morning.
We've caught up with a lot of equity market bulls encouraged by these earnings. They say these earnings have been the best we've seen outside of recoveries in decades. That's the reason for this bull market to continue. Do you have doubts?
I think it's absolutely the reason for this bull market to continue. I think just thinking through, we've had a big move in equities. We've had a good reaction to earnings and earnings revisions. And when you look at where interest rates are here, we just think that this is a time where we may see a pause and people start to say, you know what, long bonds look attractive here. And these are levels that we haven't seen in a very long time. So it's just a matter of relative risk and reward between the two asset classes.
That's a line we've got to follow up on. Long bonds look attractive here. What makes them attractive?
Well, I think it's just looking at interest rates. And if you think about what's happening in the political backdrop, to Lisa's point, of course, we don't know what's going to happen in the next day or week, but we do believe that eventually there will be a realization of some sort of resolution with the war in Iran. And I think at that point, people are going to get, and you're already seeing it, they're going to get more constructive around bonds. And so that's why we see rates, having an opportunity here to fall, bond prices appreciate. And we've had such a strong move in equities here. They are pricing in a lot of optimism. So we think the bull market continues, but probably time for a pause.
Are you seeing any of your clients actually seeing long bonds as a competitive asset to U.S. equities for the first time in a long time?
Well, we haven't actually seen people sort of talk with their wallets yet. We're not seeing a rotation, but we do think that people, when they think about a risk-free or a lower risk asset versus a lot of the risk that's built into equities, from an equity risk premium perspective, that you will start to see people look at rotating into bonds in the context of our current risk-reward outlook.
Well, this raises a key question, and different people have different outlooks on it, which is how contingent is the U.S. equity rally to the idea that the Federal Reserve will keep cutting rates at some point, right? How contingent is this rally on the idea that rates, all things being equal, are going to head lower? What's your take on that?
Well, when we started out the year, part of our thesis around higher equities was related to an easing monetary policy, just like many other market prognosticators. Obviously, that's not in the cards for this year, yet we've still seen equities perform very well. So I would say that equity upward price movement is not necessarily contingent on the Fed cutting rates throughout the rest of the year. The big story that's kind of overtaken the Fed narrative has been earnings. Earnings have been very supportive of a higher move in equities for a whole cast of reasons. And we still see potential upside in earnings throughout the year. I mean, when you look at what's been driving the earnings, the upside, it's been in the technology sector. It's been as a result of positive earnings revisions in energy, ironically. I mean, the S&P 500 is much more levered to technology and communication services than it is to the negative headwind that higher oil prices bring about. So we think there's still more upside in earnings. There's, of course, the productivity story coming from AI, which hasn't really borne out yet when you look at what companies are saying. They're not really talking about realizing productivity in the rearview mirror. It's more perspective.
Do you think this Fed could look through the oil shock?
I think the Fed is already looking through the oil shock. Now, the question will be, right now, it looks like we're forecasting or projecting about one interest rate hike towards the end of the year. Now, things have really shifted from the cuts towards the hikes, but I think you could actually build a story, particularly if you have an agreement with Iran that this is transitory and that this is primarily energy-related inflation. And so that's what you might start to hear in the Fed language.
If we were to see an agreement, would your neutral view on equity start to turn a little bit more bullish?
Well, I think that, equities have been able to look through the conflict, look through inflation. We've seen that even, when equities started to rally more recently, it was at the announcement of the temporary ceasefire. So I think that if you saw an agreement, you would see a modest move in equities, but I'm not sure you're going to get that big move that we've already seen so far. I mean, I think that's already starting to be priced in. Because it's so unpredictable, and you pointed that out, Lisa, day to day, what's going to happen and what this agreement is going to look like and what's going to be in that agreement, I would suggest that we shouldn't be making decisions on the basis of an outcome of this war, but really go back to the fundamentals. And the fundamentals are very strong.
Leslie, it's good to see you. Thanks for being here.
Thank you.
Thanks for dropping by. Leslie Marks there of Mackenzie Investments. Future this morning with a bounce up by 0.7% on the S&P. You'll notice the outperformance on the Russell. We saw that through last week. Small caps outperforming, equal weight outperforming.
And who underperforming? Magnificent Seven, which actually lost value on the week, even with the 8th consecutive weekly gain. And this speaks to, even if, say, we do see some sort of resolution, what's going to get bid up? It's going to be the cyclicals. It's going to be those that are more exposed to oil prices. You might actually see a little bit of an underperformance from some of the high flyers at the same time. Still, markets will be up.
That was Altman's point over at Barclays, that maybe that was a risk, a headwind to the overall index, that you actually get a resolution in the Middle East, which is difficult to really get your head around.
I was struck by something that he said, which is potentially the bigger risk is missing on the upside. And I think a lot of people are trying to get ahead of that risk. So how many people are not hedged to the downside because ultimately they're just discounting it altogether?
Got a bounce this morning, this Tuesday morning. Good morning to you all. Let's get you an update on stories elsewhere with your Bloomberg brief. Yahara's back with us for more. Hey, Yahara.
Hi, John. U.S. and Iranian forces clashing near the Strait of Hormuz overnight, even as they tout progress toward a peace deal. U.S. Secretary of State Marco Rubio telling reporters in India that there's a lot of talking back and forth about, quote, specific language in the initial document, so it'll take a few days. China is restricting overseas travel for top AI professionals at firms such as Alibaba and DeepSeek. The move escalates efforts to safeguard strategic technology and close the gap with the U.S. in artificial intelligence. And in sports, a major shakeup at one of Europe's top football clubs. AC Milan is parting ways with several top managers after a directive from its owner, Redbird Capital Partners. The club firing its CEO and head coach after calling last season's performance an unequivocal failure. That's your Bloomberg brief. John?
I'm ready to step in. I really am.
I would love to see that.
Of course.
Liverpool
Just
won.
Ridiculous.
Just letting you know.
Things are not going well in Italy, are they?
I mean, it's been brutal.
The national team, if you're a Milan supporter like I am, not going well.
No.
Over at Ferrari, they're launching the Nissan Leaf with a Ferrari badge on it.
Honestly, which evidently is in a bucket with cut-up spaghetti and cappuccinos after work.
Yes, ketchup on pizza.
Evidently, I'm there too, because I actually thought it was innovative. If it were $70,000, I'd be interested.
Maloney should step in. Up next on the programme.
What, design an engine?
No. Stop it from launching, all right? Reigniting tensions with Iran.
These incredible men and women gave their lives to ensure that the world's #1 state sponsor of terror will never have a nuclear weapon. Oh, and they won't. They will never have a nuclear weapon.
Up next, we'll catch up with Henrietta Treyz of Veda Partners, live from New York City this morning. Good morning. Still trying to work out how they got on the news wheel.
Someone's trying to troll you.
Clearly.
Ferrari.
And now I'm wound up today.
Yeah, well, I think that Ferrari just was like, you know what?
Come on.
You say that we're in that bucket?
More on the Luce a little bit later. 15 minutes away. Important takes on this programme. Futures right now on the S&P up by 0.7, on the Nasdaq up by 1 percentage point, on the Russell up by 1 percentage point and change off the back of this move in the bond market, 2s, 10s and 30s. Yields down across the curve. We're down by 7 at the front end, taking its cues from this in the energy market. WTI this morning pricing off Friday's close. We're down by 4%. Brent, of course, pricing off yesterday's close. So pricing in the escalation overnight. Directionally, you'll see this move here up by 2.8%, $98 and about 80 cents. Under surveillance this morning, reigniting tensions with Iran.
These incredible men and women gave their lives to ensure that the world's #1 state sponsor of terror will never have a nuclear weapon. Oh, and they won't. They will never have a nuclear weapon. We're having victories all over the place, more than we've had in many, many decades.
So here's the latest this morning. The US and Iran exchanging fresh strikes near the Strait of Hormuz. Uranium supplies remaining a sticking point while both sides hail progress on a deal. Bloomberg's Tyler Kendall joins us now from Washington. And Tyler, I think that's where the tension is right now. They're both talking about progress, but the sticking point is the ultimate sticking point to get any deal.
Right. And John, at this point, we've heard from the U.S. that it appears that we would see a phased agreement if we see any agreement at all, which would postpone those negotiations when it comes to Iran's nuclear program and what any potential curbs would look like. Because U.S. officials over the weekend did signal that progress was being made towards this memorandum of understanding, which our understanding is would first see an extension of the ceasefire, perhaps a reopening of the Strait of Hormuz, and the U.S. lifting the naval blockade. blockade in what appears to be a goal to decrease the pressure on global oil supplies, but raising questions about just how sustainable lasting peace would be. In fact, those questions are even being raised by some Republicans and more hawkish members of the Senate here in Washington, who are concerned that an approach like this could ultimately lose the U.S. some leverage when it comes to if the U.S. would give up its naval blockade in exchange for Iran to limit its grip on the strait, as well as an unfreezing of Iranian assets, which we know is something on the table, including the fact that we saw an Iranian delegation arrive in Doha over the weekend, which included Iran's central banker in what appeared to be a bid to try to grease the skids for some relief when it comes to the U.S. looking at Iranian assets. John, at this point, the U.S. has really defended its approach. We heard the U.S. Secretary of State Marco Rubio overnight saying that President Trump is committed to only reaching a good deal. If he doesn't get a good deal, then there will be no deal at all.
Tyler Kendall with the latest down in Washington. Tyler, thank you. Henrietta Treyz of Veda Partners writing this. President Trump has until June 2nd to reach a final deal with Iran or face the risk of Congress ruling against military escalation while negotiations are ongoing. Henrietta joins us now for more. Henrietta, just familiarise us all with the calendar. What's special about June 2nd?
Yeah, I would start with last week. Last week, the House Republican Conference was this close to voting to approve a war powers resolution that would have resisted the president's or limited the president's ability to perpetuate the war. The Senate Republican Conference simultaneously is battling internal fronts about $1 billion in funding for the ballroom, $1.776 billion for January 6th insurrectionists, a fight over the fact that the president is trying to unseat and is succeeding in unseating reliable Republican voters across Kentucky, Indiana, Louisiana, North Carolina, and it's really disrupted the president's control of the Senate Republican Conference. So when you think about what happened, in order to keep the peace and prevent an uprising, the leaders of both the House and the Senate sent their members home. And they're going to be gone until January 2nd. So the president effectively has the rest of this week to coordinate, get some resolution to the Strait of Hormuz, or a war powers resolution bill is in a place where it can pass in both the House and the Senate. And that's a problem.
Henrietta, in the Senate, what Republicans are going to vote for that, go against the president?
Senator Bill Cassidy in Louisiana, Senator Tom Tillis could flip, Senator Susan Collins of Maine, Lisa Murkowski of Alaska, and one more that I'm blanking on at the moment. But there are as many as 5 Senate Republicans who are willing to cross the aisle right now.
How much is the president trying to placate some of these Iranian hawks? You know, Lindsey Graham was very prolific and busy on Twitter over the weekend. And given the fact that the president started to bring in this idea of an expansion of the late Abraham Accords, you started to hear him flip and say that this is a brilliant idea, could change the Middle East. Is the president now adding to more deals he needs to get done when it comes to Iran to placate his own party?
I don't know that it's necessarily to placate the party. There are members like Lindsey Graham, Senator Wicker, who want the escalation of military force to perpetuate. They want another round of air bombing to take out what is now understood to be 70% of missile capabilities that Iran has back in its control. So there are members that are looking for more military escalation, but the war is uniquely unpopular with the American public. And you guys were talking about the polling data earlier. The polls of American consumer sentiment are absolutely biased. They're a political barometer now, and they have been for, at least 5 years. But you don't get to the thresholds that are this low without also losing Republican support. The president's down 18 points with Republicans since January, and that's largely because of the war. So if the goal is to just end this, get the strait reopened, there are 2 ways to do it. You either expand the pie and make the deal that you're working out with Iran look more comprehensive, like acknowledging Israel, for example, as you're alluding to, or you go in with the military component and you really try to re-effectuate regime change, if at all possible, or at least regain control of the strait, which we do not have right now.
Henrietta, if the president is losing popularity of the Republican Party, then why is he able to unseat incumbents with such incredible unanimity? I mean, we've seen that one after another, and Texas has another primary today where potentially we could see Ken Paxton take the lead over John Cornyn.
Primaries. That's it. Like, who are you turning out? Who is voting? I mean, the average bear doesn't vote in a primary. Very enthusiastic, hardcore Trump supporters, hardcore motivated party members of both sides. Democrats and Republicans are the ones who turn out for a primary. So if you are inclined to be a regular, routine go-getter voter, you were the one that is voting in a primary. So it ends up being a more extreme demographic. And so that's true on the MAGA side as well as on the left.
What do you think that means for the fall elections, the midterm elections, that a lot of people have said probably will go Democratic? There has been a lot of redistricting. There has been a move to the extremes on both sides. What do you expect in terms of just how much this could shake up the resolution of that vote?
I'm at 95% odds that Democrats win the House, and the odds of the Democrats winning the Senate have been creeping up all year, largely because of the war, although there's a lingering hangover from the deaths in Minnesota from ICE and, of course, the tariffs that were also unpopular. What you want to look at is the generic ballot. As we've discussed in the past, the average American doesn't know who their congressman is. So when you look at what the parties want, the latest Wall Street Journal poll shows a +9 lead, +8, I think, 8 or 9 lead for the Democratic incumbent. That means that Democrats are galvanized. They're encouraging the Democratic Party. They are happy to get out and vote. They're fundraising, and that portends a win. So my odds on the Senate side are still 45%. The map favors Republicans overwhelmingly. Democrats would have to pick up Texas and Alaska and Ohio and states that have gone for Trump reliably for years. In the case of Alaska, by, I think, 14 points, Ohio by 8 points. So the map is really difficult, but it's trending in that direction. You can see the anxiety, as I described, from the Senate Republican Conference.
Henry, it's basically June. What would the Republicans need to do this summer to turn it around?
I don't think that there's really a path to that, to be honest, Annmarie. When we got into this year, gas prices were on average $2.81. Now we're at $4.50, and Americans don't like it. If you open the Strait tomorrow, you've got to deal with the fact that there's 80 bombed out facilities across ports, refineries, oil producers that are bombed out, and that will take 1 to 3, maybe even 5 years to restore. So we're not going to get gas prices back to where the American public wants them to be. And that's a reality the Republican conference has to face because they made the decision to go into this war. If you think about gas prices dropping twice as slowly as they rise, we're talking like October, November, December before we get anywhere near a 3 handle. 305, 310, 320, anything that Americans would consider normal. 450 isn't going to cut it.
The midterms feel like a lifetime away still. Sitting here in May. Henrietta, thank you, but I know time's passing quickly. Henrietta Treyz of Veda Partners. I found that Q1 felt like a lifetime. Q2's wrapping up very, very quickly. I want to bring up this stock very quickly. This move here. BP in London trading. Check it out. Down by close to 4%. This statement just dropped. Press release from the company. Reading as follows. The board of BP announces that it has today unanimously decided that Albert Manifold should no longer serve as chair and director with immediate effect. This follows serious concerns raised to the board related to important governance standards, oversight and conduct. Amanda Blanc, the senior independent director at BP, said the following. I'll read the quote for you. Albert has helped bring a welcome focus and pace to BP's transformation. However, the board has been surprised and disappointed to learn of governance, oversight and conduct issues it deems unacceptable and has taken decisive action. That stock is trading lower by about 3.6%.
Yeah, they named Ian Tyler as interim chair and with immediate effect as they try to replace the CEO. Real question here about what the strategy is going to be. BP has sort of fluctuated between moving to more green energy and not. Well, we're going to learn more about exactly what happened here. I'm going to keep looking to see what that potential malfeasance could be.
Well, this is the issue with this statement. It doesn't give any details on what this, quote, serious governance concern is. And if it's so serious, I think they would obviously need to be pretty transparent with their shareholders about what exactly happened.
We'll keep tracking that story for you. The stock is lower in London, trading by around 4%. Coming up on the programme, Calvin Say of BNP Paribas on the health of the US consumer, plus Danny's back. She's got your morning movers. Shares of Micron rising on a potential breakthrough in China. The stock is up at a pre-market by 6%. Equity futures firmer by 0.7% on the S&P 500. On the Nasdaq, we're rallying by 1 full percentage point. 3-day winning streak coming into Tuesday on the S&P. We're about to make it day 4, very close to all-time highs. Catch-up trade in the bond market closed yesterday, open today. Yields lower across the curve. 2's down by 7. 10's down by 8 as a break of 450 off the back of this move in the energy market. WTI pricing off Friday's close, negative by some 4 to 5% throughout much of this morning so far. That's helping the trade in the bond market, helping the equity market just a little bit more.
You know, I noticed that the market rallies more on the potential of a deal than it does fall on the potential for some sort of re-escalation. The faith that something will really transpire here between the U.S. and Iran seems to be very strong. People want to move on very strongly from this. They want to feel good about some of the less loved names than, say, the Magnificent Seven, and they're using every excuse they can to do that.
It's still difficult to move on. You see the headlines overnight. If you look at Brent pricing off yesterday's close, Brent this morning bouncing back just a little bit, not too much drama, but ultimately we're told a deal's going to be struck. OK, then why is Iran laying mines in the Strait of Hormuz if the Strait of Hormuz is about to reopen?
It's a very good question. Unless it's some extreme scenario where at the very end of a negotiation, everyone's trying for the final bits. The real issue is neither Tehran or Washington have changed their red lines. So it's hard to see a negotiation, a real deal opening up. I think it's important to remember that there's really two negotiations going on. We've been talking about this for weeks now. One, just to reopen the Strait of Hormuz, and two, something more permanent when it comes to nuclear. And even what seems like maybe some thought was going to be easier in terms of Strait of Hormuz is not so simple.
Lisa was done weeks ago. You were done with this weeks ago. You're not alone.
Okay, the Peanuts cartoon? I don't know, you've probably never watched it. But when the adults speak, you just hear wah, 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 wah. That's essentially what happens when people start.
That's how the market feels like.
100%.
Is that how you feel about me?
I'm in a bucket. I mean, I'm in a bucket with cut spaghetti.
You can settle that in a moment. As we count you down to the opening bell, 2 hours to go. Let's get you some single names, some morning movers. Danny has more. Hey, Danny.
Hey, John. The semis, the chip makers are rallying this morning. For one, they just have become this high beta sector for the S&P 500. When it rallies, these things rally. But a couple other things going on. For one, Huawei out with some more advancements. That's leading to optimism over the sector and the chips that will go into those devices. And for Micron specifically, the president name-checking the company at a rally on Friday, calling out how much they're investing into the United States. They have committed about $200 billion to build out manufacturing capabilities in the United States. So those shares up more than 6% in the pre-market. Some deal news. Eli Lilly will be buying 3 different vaccines, getting back into the infectious disease treatment. It's something that a lot of these vaccine makers or drug companies are rushing to get back into. Shingles among the various vaccines that they have bought from different companies. Those shares up 1 1/3%. Finally, anything having to do with space is rallying a lot this morning, all in anticipation of the SpaceX IPO, because if SpaceX can be $2 trillion, why can't these companies be worth more? AST, one of them, they make the satellites that are launched into space. Those shares go up nearly 7% in the pre-market, John.
Hey, Danny, thank you. Thank you for the update. More from Danny in the next hour. On our radar this morning, the US and Iran exchanging fire just hours after President Trump hailed progress on a peace deal. The US Secretary of State Marco Rubio saying negotiations are still underway.
It's going to take a couple days to settle on, even down to the disagreements over a word, sentence. If there's going to be a deal, we're going to have to work through that. It's either going to be a good deal or there isn't going to be one.
The Strait of Hormuz and Iran's nuclear program remaining key factors in peace talks. Elsewhere, AI training firm Wall Street Prompt is cashing in on automation. The firm charging $25,000 a day to teach bankers how to use AI tools. Sources telling us here at Bloomberg the company has worked with T. Rowe Price, Citi and Bank of America. And finally, shares of Ferrari falling after unveiling its first fully electric vehicle. The luxury car maker facing negative reviews from critics and analysts. Many believe the car is too similar to other popular EVs.
You know, I would buy this car for $70,000, $60,000, not maybe $650,000. I will just say the executive chair said this: Ferrari Luce is not a responsible change. Whatever.
Come on.
It is a deliberate decision to lead what comes next.
I'll take over. So this is what I thought was the most interesting. Rolls-Royce commented on their Instagram, even we have standards. Aston Martin, we wouldn't be caught dead in this. Tesla, you spelled, quote, software update wrong. No one likes this car, except maybe people who were going to go out and buy a Tesla, to Lisa's point anyway. But if you are buying a Ferrari, and you potentially are buying this Ferrari because you also think in the future it's going to have more value, this is not the car for you. And I'm just confused. They might lose their hardcore fans with this EV experiment.
Clearly, Johnny Ives wanted to design a car, and Johnny Ives has designed a car. Johnny Ives has not designed a Ferrari, and there's a massive difference. The question, and I think it speaks to why the stock is down this morning, is why Mr. Alcan over at Ferrari and over at Fiat allowed this to ever happen? That's the question I've got this morning. How on earth did Alcan & Co. sign off on a car that looks like that and stick a Ferrari badge on it? That is a judgment call, and I think that is why the stock is down this morning.
What is their goal with this? I think that is a fair question, given the fact that they haven't had an EV until now, that this is a flooded market with electric vehicles that look something like this. And Ferrari has been a selective sort of aspirational purchase. They said that they are going to limit the purchases for this too. Let's see how they actually do and whether they gain traction. But I think that is the key question. What is the ultimate strategy going forward?
When you had Ferrari's chief marketing commercial officer give this interview to the Financial Times, he said, to my petrol heads that I meet, I always tell them, please don't buy the Luce. The key driver the car maker is targeting is someone who already owns an electric car. And of the people invited to its launch event, they weren't Ferrari drivers. So they're trying to expand. But yet, once again, you might end up ruining the brand and the core individuals that love Ferrari, like our Jonathan Ferro.
Yeah, I get why they're doing it. I understand that. The regulations are pushing them in that direction. For me, take the EV out of it. Forget that it's got an electric engine. It's the design of what it looks like that's the problem. If you ever get the opportunity and you find yourself in northern Italy, go to Modena and go to the Enzo Ferrari Museum and you walk in and there's some beautiful cars and you track the history of progression of how these cars have been built, the engines, the designs. You start with something like a 166 mm. It's just stunning, this car from the 40s, 50s, and the heritage that builds from there. If you dump that into that museum, it's going to look like a massive eyesore. It has no place in the heritage of Ferrari, no place whatsoever.
So again, who's going to buy the loose, and what exactly are we going to see with
Grandma,
respect
what are you doing? Come on. Stock is down.
Luce.
She knows.
Luce.
She knows. She knows.
Go cut your spaghetti.
Drink your cappuccino in the afternoon.
I totally
Put ketchup on your pizza.
Okay, that's
pineapple.
That's disgusting.
Come on, Ferrari down this morning by 6%. Let's turn to the consumer and the US economy. Sentiment falling to a record low as rising prices weigh on shoppers. Traders looking for more insight with another busy week of retail earnings on deck. Calvin Say of BNP Paribas writing the consumer has been resilient. Fiscal stimulus, wealth effects and monetary stimulus are offsetting pain at the pump. Calvin joins us now for more. Calvin, good morning. Good to see you.
Good morning.
Welcome to the programme. How much weight should we put on that record low consumer confidence read on Friday?
Not very much. A lot of these consumer sentiment numbers have been coming up and down, and they really haven't driven actual consumption. If you look at what people are actually doing, retail sales have remained strong through this war. And exactly as we say, there are three things propping up the consumer right now. It's the wealth effect, it's fiscal stimulus, and we also think, really importantly, monetary policy is very stimulative at the moment.
I wanted to pick up on the monetary policy call. This seems somewhat unique to you and a team over at BNP Paribas. I think a lot of other banks are getting there. They're just not quite there yet. The risks of a hike, and maybe this year. Could you lay them out for us?
Sure. We've been highlighting that there are two prerequisites necessary for a hike. One is either long-term inflation expectations show more signs of unanchoring, and the other is potentially the labor market tightening further. We're already starting to see signs of this. As you saw last Friday, the University of Michigan report 5 to 10-year inflation expectations jumped in a really big way. And the Fed needs to be worried about this. This is exactly what we saw in the 1970s when we had a rolling series of shocks to inflation that led to an unanchoring of inflation expectations. And that prompted the Fed to have to do a lot of hiking to combat that. So that's something that we're very worried about. And we're also worried about the risk that maybe we might be, over the next few months, seeing a labor market heat up here. That could also get the Fed toward rate hikes.
We're not there yet. And a lot of people push back on that and say maybe it's not accommodative. Maybe we're just seeing a productivity boom and we're seeing all of these positive things that are happening in equity markets that can keep risk assets elevated, even with rates at a relatively restrictive pace. How much do you get that? How do you push back against that argument?
It's pretty simple to me. If monetary policy really were restrictive, you should be seeing progress on inflation, maybe strip out all that volatile stuff. You're still not seeing any progress in things like non-shelter services inflation. And you should be seeing progress on labor market. The unemployment rate should be going higher if monetary policy were restrictive. But it's been very range-bound, and we think there are actually downside risks on unemployment rate over the next few months.
What happens if the Kevin Warsh-led Fed does not hike rates, right? I mean, how potentially big of a mistake would this be on the long end of the yield curve? And how much would bond markets revolt?
We don't think that the Fed needs to be hiking now. We just think that the conditions will likely be in place at some time this year for the Fed to seriously have to consider hiking rates. Let's say our scenario plays out with the unemployment rate is making a move toward 4% and inflation expectations show signs of unanchoring. we think the Fed is going to hike. Warsh is just one person. He's 1 out of 12 votes. And as you can see in the minutes, as you can see by Christopher Waller's speech last week, even the doves are moving in the hawkish direction. And one person is not going to be able to stop a hike if the monetary policy conditions suggest that we should be seeing one.
What kind of consumer will we see then if they really think inflation is going to be much higher?
The consumer, for now, again, we think is relatively supported. We have stimulus coming through multiple channels.
Doesn't that dry up at some point? Aren't they using that extra stimulus right now for higher energy costs?
In the first half of the year, we think fiscal stimulus is going to be a big supporter of consumption. That's going to wane by the second half of the year. But our feeling is that the labor market is going to remain tight. I'll just give you a very quick anecdote. We just finished Q1 earnings season. The S&P 500 is expected to see 20% earnings growth over the course of the next year. The corporate sector is on fire. Meanwhile, at the same time, we've seen 0 jobs added to the U.S. economy over the last year outside of healthcare. Companies just simply, we think, don't have enough labor. So we think we could see a pickup of hiring throughout the summer and into the end of the year, and that we think should also help support consumption.
A pickup in wage growth as well?
That pickup in wage growth isn't going to come immediately. We think it's going to require a tighter labor market, which is why the Fed currently is not concerned about the labor market. And that's why our threshold is around 4% on the unemployment rate. If we start moving to and toward 4%, at those levels, then you could start getting much more concerned that wage growth may begin to perk up in the economy.
Final question, how many Ferrari Luces will we sell in this economy?
I'm not buying one, but I'm not sure who else.
Don't have to go there, Cav. Appreciate it. Thank you, sir. Thank you. Cav Desai there of BNP Paribas. I'm not sure that the US market is the market for it, you know, ultimately.
I mean, who is the market for it? Look,
might be China, don't know.
You really want to go back to this? I think the loose discussion, I think, look, people, you clearly...
I got a great message from a Bloomberg subscriber, which was limit it to one. Just produce one. Just limit it to one.
I think it's actually bold. Look, I'm going to be the contrarian here because I feel bad.
By all means.
But
who do you feel bad for?
I think the craftsmanship. I was reading about how quickly you can accelerate to 60 miles per hour. I think it's 2.5 seconds.
Any electric engine right now, right?
Well, it's faster than that. And the fact that it has a maximum of 300 kilometers per hour is pretty impressive. I think that the power that can be sustained, I think it's good to be bold. I don't know that the design is the boldest that it could have been, but still, and trying to reconcile the sort of roar that people tend to enjoy versus the non-existent
You're
noise.
entitled to your opinion. You're not entitled to making up Italian words, though.
Yeah,
right?
basta.
OK. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Yahara has more. Hey, Yahara.
Hi, John. President Donald Trump is requesting that several Arab and Muslim countries join the Abraham Accords in exchange for a deal with Iran. In a Truth Social post, Trump calling on Saudi Arabia, Qatar, Turkey, and Pakistan to sign the accord, which would effectively see them normalize ties with Israel. Iran's government may ease the months-long internet blackout. The official Islamic Republic news agency saying a government task force voted on Monday in favor of returning internet access to conditions in place before January 2026. Now the latest on the overheating chemical tank in Southern California that forced 50,000 people to evacuate overnight. Orange County fire officials said many residents could return home, but those closest to the site are still under evacuation orders. Officials say the risk of a major explosion has now been avoided. That's your Bloomberg Brief. John?
Yahara, thank you. I just admire Lisa's determination, consistency to be contrarian at all times. And it now finds you on this side of this argument with this thing.
It's definitely not the easiest argument to keep going with, but I'm going to keep trying.
I admire it.
Thank you. I appreciate
so consistent through the commercial breaks. It's non-stop. Up next on the programme, reforming the Federal Reserve.
I will lead a reform-oriented Federal Reserve, learning from past successes and mistakes both, upholding clear standards of integrity and performance.
Up next, we'll catch up with the former New York Fed President, Bill Dudley, live from New York City. You're watching Bloomberg TV. Stocks here bouncing up by 0.7% on the S&P 500, on the Nasdaq up by 1 full percentage point. Catch-up trade in the bond market, yields lower After a three-day weekend here stateside, we're down by 7 basis points on 2s. We're down by close to 8 on 10s, 448 on 10s, and just about holding on to 5% on a 30-year. Under surveillance this morning, reforming the Federal Reserve.
I will lead a reform-oriented Federal Reserve, learning from past successes and mistakes both, escaping static frameworks and models, and upholding clear standards of integrity and performance.
So here's the latest this morning. Fed Chair Kevin Warsh preparing for his first week leading the central bank as investors price in higher for longer rates. The former New York Fed President, Bill Dudley, writing, the prevailing wisdom is that the Fed will tighten monetary policy later this year. Bill joins us now for more. Bill, welcome to the programme. I enjoyed the piece. I just want to get to one important line in there, whether it's credible for this Federal Reserve to say that monetary policy is indeed still restrictive. Bill, what's your take on that?
I just think you have to look at the economy's performance over the last few years. We've been at this level of interest rates or higher since November of, I think, 2022, and yet the economy is continuing to grow. We're still at full employment. So where's the evidence that monetary policy has actually been restrictive? If it had been restrictive, the economy should have slowed down, the unemployment rate should have risen. So I think the case for cutting rates now is actually very, very weak.
Given that, Bill, there's a real question here about the housing disinflation that people point to, as well as we haven't seen wage inflation accelerate. In fact, you've seen it decelerate. We've seen the worker not participate as much as companies in terms of just their profit margins. At what point does the Fed have a right to keep looking at that rather than the overlying GDP growth?
I think they do have a right to look at that. I mean, I think the big question is the tax refunds that have boosted people's disposable income over the last few months the key driver? And as we get to July, August, September, will consumer spending turn over? Or is the fact that financial conditions are so easy, is that going to be the dominant influence in terms of supporting consumption and economic activity? I think the wage trend is something that is positive in terms of those who think that inflation can come back down to 2%. But that could turn. I think the problem here is that we've been above the Fed's inflation target for more than 5 years. And there is a risk that inflation expectations do finally become unanchored. And the University of Michigan preliminary result last week showed that 5 to 10 year inflation expectations did tick up quite markedly. Chris Waller's focused on the 2-year inflation outlook, 2 years forward. That's also moved up. So I think the Fed is concerned that they're starting to lose credibility because they haven't been able to get inflation back down to 2%.
How much is this Fed sort of conditioned by the pre-pandemic reality of low rates in a way that has made them overly dovish to meet the moment? And frankly, having to reconcile their overly dovish stance with fundamentally stickier inflation as a reality?
I agree with that. I mean, I think that if you look at the level of real rates prior to 2007, the real rate embodied in the Taylor rule, for example, is 2%. The Fed's assuming today that the level of real rates adjusted for 2% inflation is 1%. So it's very possible that monetary policy today is not restrictive at all because real rates are higher. And there's a reason to think that real rates are higher. Look at the investment spending boom caused by the AI. That's raising real interest rates because it's increasing the investment demand in the economy. The fiscal path of the U.S. is also raising real rates because it's diminishing the supply of savings available for investment. So I think there are good reasons to think that real rates are higher than they have been in the recent past.
When you have Christopher Waller saying that his current policy position is to hold rates steady for the near term because policy risks have changed, do you find it interesting that he was able to look through the potential tariff impact on inflation, but he's not when it comes to the oil shock?
Well, I think they're really the same in terms of both being likely to be transitory. The real question, though, is how does it get bodied in inflation expectations? And I just think the Fed is sort of pushing the limits of their credibility to claim that, trust us, that we're going to get inflation back down to 2% when we haven't been able to do it for the last 5 years. So I think he's getting nervous that they can't sustain this. There's also a big risk here. I mean, Kevin Warsh is coming in. The president wants lower interest rates. So you can see all the elements in place where the Fed should, tighten rates sometime later this year, and they don't because of the pressure from the president. So the questions about the Fed's independence, how willing Kevin Warsh would be willing to buck the desires of the president, also weigh into this situation. So I think that if the Fed's independence wasn't under question, then it'd be more likely that inflation expectations would stay well anchored.
So, Bill, there's an odd tension in inflation expectations right now. Consumers don't trust them. haven't for a while. You see that in the recent survey. They're expecting inflation to be way above their particular target for a significant period of time. Bill, market-based inflation expectations, does the market trust them?
Well, I think if you look at the very longer term expectations, for example, like you look at the Treasury inflation protected securities market versus nominal Treasuries, five years out, that looks fine. I think the issue is that an accurate measure of what households and businesses think today? And I think that's why Waller brought up what's inflation going to be 2 years from now for the next 2 years. And that has started to tick up. So that's not so far over the horizon. 5 years is a pretty long time. Yeah, I can trust the Fed's going to get inflation down to 2% in 5 years. Are they going to get it down to 2% by the end of 2027?
Is this a recent problem or a problem that's persisted for some time under Chairman Powell?
I think it's a more recent problem in the sense that the credibility that monetary policy is restrictive has really started to diminish as the economy has continued to perform well. So that's really if the Powell thesis was correct, the policy was restrictive, then the economy should have slowed more and the unemployment rate should have risen more.
Certainly this data is testing that thesis. Bill, appreciate your time. Great column today. Thank you, sir. The former New York Fed President Bill Dudley on Bloomberg Opinion, this line: it isn't credible to judge monetary policy as restrictive when short rates have been above current levels for more than 3 years and the unemployment rate remains at a level judged by monetary policymakers to be consistent with full employment and stable inflation.
He's not alone. Increasingly over the weekend, a lot of different economists came out with similar types of tones. Michael Darda, what if the Fed is actually below neutral? Matt Luzetti talking about how maybe the Fed bought itself too much insurance with the 175 basis points of rate cuts. There's a deeper question here. How can any Federal Reserve be hawkish when they're dealing with an overhang of a fiscal deficit that is not cooperative with what they're dealing with, right? I mean, ultimately, math would suggest that as the deficit goes up, people have to pay more for the borrowing, and that is something that is just a natural consequence. The Fed doesn't want that, right, because that's not the kind of tightening that they want to see. And as these politically appointed members come on, they've increasingly tended to try to look past inflation. This is the dynamic that we have here at hand. So there is a question about the independence regardless of the person, simply because of the deficit and the structure here.
There's a deep irony to all of this that's worth highlighting. It's odd we're even having this conversation about central bank independence. I understand the president was pretty wound up by the fact that the old Chairman Powell, cut interest rates 3 times heading into the election. He also cut interest rates again last year 3 times by 75 basis points. And the conversation we're having now, today, is that the Chairman Powell Fed might have been too dovish. And still going into this month might have been too dovish. And yet here we are talking about independence because the president was unhappy with the current chairman, who everyone is saying might have been too dovish.
Key question for Kevin Warsh. Can he maintain the too dovish Powell Fed, given the mandate that he's received from this president?
Redefining dovishness, aren't we?
We are.
It's not cutting rates, it's just keeping rates on hold. Up next, Mona Mahajan of Edward Jones, Amanda Liner of Goldman Sachs, Greg Daco of EY Parthenon, and Richard Bernstein of Janus Henderson from New York City. The third hour of Bloomberg Surveillance just around the corner.
It's a market that is looking at reasonable growth.
People feel like they have to put money to work.
Stay diversified, you stay disciplined, and you get rewarded.
The market could get gut-checked here from a momentum unwind.
Were it not for AI, this would be a very, very different story.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The third hour of Bloomberg Surveillance starts right now, and your price action scores look like this. Equity futures bouncing by 0.7% following a 3-day weekend stateside. The Nasdaq up by 1 percentage point. The outperformance on the small caps last week could get more of the same later on this morning with this move in the bond market. 2s, 10s, 30s, yields lower. 2-year notes down by 6 basis points, 4.05%. 10s down by 7 to 4.48. Taking cues from the energy market this morning. WTI following Friday's close, negative by 4 percentage point, with all the good feelings and vibes over the weekend about getting closer and closer and closer to a deal in the Strait of Hormuz.
Yeah, we're 95% there. There's a question here as we go forward about what kind of blowback there will be in terms of the decline in inflation that we could get if this is resolved, right? The idea of going back to where we were before the conflict with Iran began. It seems like in the bond market, there is a hope that we will disinflate as quickly as we inflated. That, I think, is a key question. How quickly can we see the inflation that's been worked into the system as a result of the conflict and in tandem with very strong earnings if there is a resolution to this conflict?
And it's confusing when it comes to the conflict because on one hand, the president is saying the talks are proceeding nicely. On the other hand, the U.S. military is actually going after Iranian boats that were then laying mines. I'm not sure how the strait, to your point, Jonathan, is going to open if there's going to be mines that are laid at the bottom of the sea, and also going after missile launch sites as well in Iran. But they are clinging to this idea of a ceasefire, at least verbally, not physically. Look what they're doing. That doesn't look like a ceasefire. To, quote, protect our troops from threats posed by Iranian forces. They want the ceasefire to maintain, but say that this is defensive in nature.
Things can change, and they can change really quickly. This from Andrew Holmhorst of Citi. If we get a deal, and these positive developments could lead to a rapid repricing of front-end yields, which continue to dramatically overprice the probability of rate hikes. Things can change really fast. So what do you do if you're the Fed? Well, the Fed's got an easy move to make in many ways in the next month. You just remove the easing bars, you slip into neutral, and you figure things out through the summer. Everyone else has put themselves in a bit of a box here. The ECB being one in the next month, because if this continues, then the ECB, based on their guidance, they're going to hike.
Yeah, and if the Fed is behind, there's a real question about the liability for the Federal Reserve. Look, the ECB is probably going to hike. That is priced in. The Fed might remove the easing bias. That's ludicrous if you take a look at some of the commentary that we're even talking about just that small step, that the next move isn't necessarily going to be a cut. The market has moved on. I think this is really important. The market is not taking forward guidance from the Federal Reserve anymore. They're taking forward guidance from oil prices, from some of the data that they're seeing, and they're pricing in fully a rate hike by early next year. So the Fed may signal whatever they want, but at this point, it is just potentially to disappoint the market that already has gotten significantly ahead of them.
Governor Waller in the mix on Friday, going into the weekend. He really made the headlines. That's a guy worth watching on the committee. Very data dependent, unfairly, I think, dragged through the mud in the Wall Street Journal this morning, and I'll just say that much. This is a guy who, up until the war, was thinking about reducing interest rates because of developments in the labour market. Developments in the labour market have stabilised, and inflation expectations have picked up. If you're a data-dependent central banker, you should be changing your mind based on those details alone over the last several months.
Yeah, I mean, ultimately, can you really say this is transitory, right? Can you say that some of the increase that we've seen, the reacceleration in inflation metrics, truly is transitory when you have a labor market that seems to be on the margins tightening, getting better, when you see profit margins that are reaching the highest in decades in the aftermath of a non-recessionary period of time? So you take a look at this, the data is giving a message.
We're not talking about hiking rates 50 basis points next month. We're talking about being open-minded, slipping into neutral, being open-minded about the future. What's wrong with that?
Yeah, I mean, the future of the Fed policy, the future of electric vehicles, the future of racing, open-minded.
I don't have a problem with EVs, per se. It's not that they've done an EV. It's that it looks like that. That's the problem.
Is it the color?
It's not even the color. It's the design.
Yeah, one analyst called it a Honda Accord. Can you imagine your $650,000 EV being compared to a Honda Accord?
If a cartoon monster ate an Accord and a Nissan Leaf and spat it back out, and Alcam went over there and put a Ferrari badge on, that's what it looks like.
I think that's been done on Twitter, by the way.
Okay, has it?
Yes, I think that's where people are going.
There you go. Coming up this hour, we'll catch up with Mona Marjan of Edward Jones as investors shake off strikes in the Middle East. We'll speak to Amanda Lynham of Goldman Sachs on why private credit fears are overblown. And Richard Bernstein of Janus Henderson saying a boring portfolio is a beautiful one. We'll begin this out with stocks closing in on fresh all-time highs. The investment strategy team at Edward Jones writing, we do not think the move in yields is enough to derail the bull market. This is not a repeat of 2022. Mona Marjan of Edward Jones joins us now for more. Mona, it's good to see you.
Good to see you.
Welcome to the programme. It's not a repeat of 22. We've heard that a few times. It hasn't been until maybe later this year when people are talking about the prospect of hikes. Do hikes change the game if we get them?
You know, look, I think the market is doing the job almost for the Fed. As you all talked about earlier today, I mean, we saw yields on the 10-year move up to 470, coming in a bit now as oil prices are coming in, but nonetheless, the Fed almost doesn't have to do anything. The market is tightening conditions for investors de facto. Now, the other thing I'll say briefly is This Fed, if this was a demand-driven shock, if people were going out there really buying oil, that was driving prices up, that's one thing. Rate hikes could help that. This is clearly a supply-driven shock. Strait of Hormuz is closed. Fed rate hikes in that environment don't really solve the issue or address the issue of adding supply to the system. So something we should consider as we move forward as well.
Hasn't it demonstrated in some ways, though, that consumers can stomach these high prices, which might be a signal to other actors in the economy, and also might be a signal for us to sit here and recognise, and this is what Bill Dudley, the point that he's making, that maybe we aren't that restrictive at the Federal Reserve?
You know, look, I think with the Fed at 3.75%, inflation around 3.8%, clearly you're at least at a neutral rate, maybe slightly restrictive if you think oil is transitory. We do think the market is forward-looking. This market is pricing in, and we see what they're pricing in. WTI futures curves are looking back to low 80 levels by year end. We're looking at earnings growth at 20% plus this year. So this is an economy that has withstood very nicely oil price increases and oil price shocks. And by the way, this is an economy that is looking forward. So we saw the same thing in tariffs. As soon as the administration said 90-day pause, markets started pricing that in. As soon as we heard the term ceasefire in the Iranian crisis, markets started pricing that in. So if you wait for 100% certainty, you probably would have missed some of this move.
What kind of future can you look ahead to, though? This is the key question. Is it one driven by AI productivity gains that are monopolized by all of the semiconductor companies and the hyperscalers? Or is this a world where you start to see a broadening out, where you can see the real economy play a little bit into this narrative?
You know, we're hopeful that it's the latter. We do think the initial move, and this is usually how it works with a new technology, a new technology cycle, the initial move is by the infrastructure players of that technology. So think about semiconductors, think about parts of the data center build out that we're already seeing a tremendous move in. Over time, we should see the beneficiaries of those productivity gains start to see some gains as well. So we continue to like areas like industrials, areas like, well, comm services that can continue to benefit from productivity spreading. Now, I'll also say broadly, from a market cap perspective, we like large and mid cap. From a regional perspective, we like U.S. and emerging markets, which could be an alternative to technology in the U.S. as well. So different ways to play this over time.
I've been thinking about something since earlier this morning, so bear with me. But someone was mentioning how profit margins have been 20%. They've been the highest they've been in a very long time. You've seen incredible profit expansion at the behest of productivity, but you've seen the actual employment figures decline, if anything. Is that a feature or a bug, right? I mean, is it essentially that you're seeing these profit margins increase at the expense of jobs, or is this setting up for a jobs boom?
Yeah, you know, look, I think thus far any softness in the labor market has not really been attributed to AI. Maybe the potential of AI ultimately taking some jobs, but layoff figures, you can actually look at the survey data, only 5 to 8% of companies are pointing to AI as a reason for layoffs. So we're not seeing AI as a reason for pulling back in the jobs market. What we are seeing in the labor market is less supply and less demand overall. So supply driven by immigration reform, driven by an aging population, lower supply in the U.S. of labor. But on the other hand, we're not seeing as robust of demand for labor across corporations thus far. So that's what's keeping this unemployment rate steady at 4.3%. We wouldn't call it a robust labor market because wage gains haven't picked up in a meaningful way either. So we're not seeing that wage price spiral kick in as well.
Mona, could pick up your point about how you like parts of EM, because EM right now, for me, when I look at them, they're these economies that are really dealing with spikes when it comes to the energy crisis, way more than we're dealing with it in the United States.
Yeah, absolutely. You know, look, I think really the part of the world that is dealing directly with the spikes is probably Europe, maybe parts of Asia, to your point, but that is more international, developed, and not as much. I think EM has the benefit of not only the productivity gains, but the AI technology boom behind it. And over time, I think if we continue to see a dollar weakening environment, we could see EM gain some momentum as well. So probably more cautious on international developed to that point, but more favorable on EM.
You're very constructive on what's going on with the conflict. If it lasts the rest of the year, do you have to start to rethink some of this?
Yeah, you know, I think certainly this conflict will take some time to resolve. And I think we've all talked about, even if it resolves in the next couple of weeks, it will take some time for the strait to open, for oil prices to mitigate, for the supply to come back on board. We know that environment is probably there for the next 6 to 12 months. But to the point that markets are looking beyond that, what's the environment going to be like 12 to 18 months when we're sitting here Could actually oil supply, we know prior to the crisis, we were a little oversupplied globally in oil. We know that economies are looking to build their buffers. We know that, countries like the UAE have left OPEC, so there's more supply potentially coming from that region. Could we be in an environment where we get back to oversupply and the Strait is clearing up and we get back to global oil flows? So could we be in an environment where we're back at $60 to $70? There is a possibility of that, especially when you look longer term.
Can we finish on EM? What does liking EM mean? What does it mean to say I like EM? Do you like, I don't know, TSMC?
Yeah.
Samsung, SK Hynix, 3, 4, 5 companies? What does it mean to like EM in 2026?
Yeah, so from our perspective, we like MSCI EM Emerging Markets Index. And so probably not at the company-specific level, but several of those that you mentioned have done phenomenally well.
And they've got massive weightings in that index.
Yes, and interestingly, China itself has come down in the MSCI EM index as a weighting. Taiwan has moved higher, so there's an offset there. But certainly this is an ecosystem that has been front and center in the semiconductor build-out and the AI CapEx spend build-out. And we think over time, the growing consumer base in those economies will be beneficiaries of the productivity gains as well.
Mona, good to see you. As always, great to catch up in person. Mona Marjan there of Edward Jones on the equity market. It used to mean something else. It used to be almost exclusively, you'd see that fast money in and out of EM. It would be based on US rates, the US dollar. And now it's almost exclusively a tech trade.
Well, it used to be cyclical. Now it's secular. And that's the shift. And so when people talk about EM, they're talking about the secular shift that's really led the rally in the U.S., regardless of some of the economic pressures, because it is all tied to AI.
Futures this morning on the S&P up by 0.7%, with an update on stories worldwide. With your Bloomberg brief, Yahara has more. Hey, Yahara.
Hi, John. Just in the last hour, Iran condemning U.S. attacks on Iranian vessels in the Strait of Hormuz as a violation of the ceasefire. Iran's semi-official Tasnim news agency also saying the Islamic Revolutionary Guard Corps shut down a U.S. drone and fired at an American fighter jet in Iranian airspace. We are seeing Eli Lilly shares rising 1% in the pre-market after the pharma giant agreed to buy 3 vaccine developers in deals worth nearly $4 billion. The company is using the windfall from its blockbuster obesity drugs to push deeper into the infectious disease prevention market. And in sports, if you haven't heard, the Knicks are heading back to the NBA Finals for the first time since 1999. New York sweeping the Cleveland Cavaliers in their 11th straight playoff win. They'll be taking on either Oklahoma City or San Antonio in the finals, which tip off on June 3rd. That's your Bloomberg brief, John.
Very cool. Yahara, thank you. Appreciate it. Up next, we'll get you some morning calls, plus Amanda Lynham of Goldman Sachs seeing further opportunities within private credit. That conversation just around the corner, live from New York City this morning. Good morning.
There's a lot of nervousness, and there are a lot of jobs that do seem like they are trending towards we need less of them. What has long been thought in sort of this last generation as a solid kind of entry-level white-collar job is disappearing.
That was Sarah Kunst of Cleo Capital a little bit earlier on this morning on the great debate in the labour market and AI's impact still to come. Equity futures on the S&P 500 got into the open in about 1 hour and about 13 minutes away, bouncing back by 0.7% on the S&P 500, adding to a 3-day winning streak. Could become day 4 on the Nasdaq, up by 1 percentage point, and just a little bit of outperformance again on the small caps following this move in the bond market. 2s, 10s, 30s, yields pulling back, 2s down by 6, 10s down by 7. Queuing off this in the commodity market, WTI of Friday's close lower by some 4%, encouraged by the headlines over the weekend. But if you look at Brent bouncing back from yesterday's close, discouraged by some of the headlines overnight. So if you've taken a nice long 3-day weekend, it's back to where we were before. Some serious doubts about just exactly where we are in the Middle East.
Totally following all of that, and I'm really paying attention because ultimately it will dictate future action. Annmarie, I know that you've been following the ins and outs of this. I just still find it remarkable that people are trading off of it because ultimately we have no concept. I mean, there was a whole meme unleashed about 95% done over the weekend, which I was there for.
Right. So it sounds better than where we were on Friday, but it certainly doesn't look better than where these two countries were on Friday, because since Friday, we now have active strikes in the region on top of the Iranians going after United States aircraft and planes. So it doesn't look very good, even though the president is trying to wish cast or hope cast this deal into existence?
I think for markets, it's a single issue negotiation, reopen the strait. I think for the actual negotiation, it's a single issue negotiation. It's about the uranium, which will lead to reopening the strait if we can agree on that. We can't agree on the uranium right now. So never mind 95% done. If the 5%'s the uranium, as far as I'm concerned, we're 100% not done. That's the issue.
Well, the issue is if you're 95% done, but you haven't reestablished exactly what Iran's control is going to be over the strait, exactly how you're going to secure it, whether they're going to get fees, and you're dealing with uranium, and the idea that they can't decide, isn't that exactly why we went to war in the first place? So, you know, it's a reason why people are kind of struggling with how close we actually are.
Welcome back.
Thank you.
From the long weekend. Equities are positive, stocks are close to all-time highs. There you go. That's the equity market. Let's get you some morning calls. First up, Bank of America raising its price target on Apple to 380, saying it should have meaningful leverage in an AI agentic world. The stock is up by 0.6. Your second call from UBS, tripling its price target on Micron to 1625, citing long-term memory supply deals that could lock in pricing. And finally, Piper Sandler raising its price target on Apollo to 157, saying it's one of the best-positioned companies in the alternative space. That stock is up marginally in the pre-market. Elsewhere, private credit managers looking to offload troubled assets. Sources telling us here at Bloomberg, a number of business developers are looking to trim software exposure. Amanda Lynham of Goldman Sachs writing, we believe private credit's role in the financing ecosystem remains intact and expect to see expanded deployment opportunities. Amanda joins us now for more. Amanda, good morning. Good to see you.
Thank you for having me.
Do you think that BDCs have unfairly shaped the narrative for this whole universe so far this year?
I think you're hitting on a great point, which is I feel like the market's focus, and I think this is an appropriate shift, has moved from the redemption pressures in the retail market, which is about 15% of AUM on the most conservative calculation. And it's now pivoted to actually what also matters for liquid credit, which is the risk of a slowdown in the economy and the disruption potential in the software space. And so what we see from the first quarter data actually is a continuation of the trend that we've been noting, which is dispersion but not widespread market disruption. And you had mentioned kind of the strong risk tone, earnings, trend-like growth. That's all a pretty supportive cocktail for credit risk, both liquid and private. But I do think it's appropriate that the market has kind of compartmentalized the redemption pressures in retail, which we expect to continue, by the way. The next redemption activity window will open in June. But I think that's a bit of a known at this point.
Well, can we just stay on BDCs and software? Sure. BDCs is the total universe you've just indicated, very small. Yep. Software within that, quite large, yes, depending on which particular vehicle you're looking at. For the whole universe, are they all just loans to software companies? Give us an idea of the numbers involved here.
So a lot of the loans that BDCs hold are also held within institutional portfolios. So the BDCs are a good proxy for the broader corporate credit market. You are correct. The software on average across the private credit market is around 25% of total assets. Now, some managers flex lower than that, some flex higher. I think the debate that we are having at the moment, though, is really emphasizing this should probably be a nuanced conversation around software. For example, we're seeing different price performance in vertically integrated software companies versus horizontal. Our equity analysts who cover the space have made the point that a lot of these incumbent players won't stand still and allow their businesses to be disrupted. So I think that's the lens with which we're going into it. Not that different from the energy disruption or the retail disruption. There will be winners and losers. But even if you apply a pretty draconian outcome to the software exposure, both in terms of defaults and recoveries, in the context of the income generation of the asset class, in our view, it's not a systemic risk to the financial system. It's just a driver of dispersion. The other point I will mention is that certain vintages like 2021 and 2022 that were formed in a low-rate environment and before AI was really on investors' radar to the extent it is now are especially vulnerable.
At this point, there's a bigger takeaway, and this is what some people are saying, which is there was a reach for yield given how much money was coming into private credit. And you could see that maybe most prominently in the BDC space. But on a broader level, it doesn't make private credit as attractive as being more liquid, even if you're picking up less income. Do you agree with that type of philosophy, which we're hearing more from a lot of investors?
I think it's shifting a bit. We've seen spreads widen around 25 basis points since the end of 2025. We're seeing covenants really do stay intact, I would say, especially given the recent disruption that we've had. Look, these alternative asset classes, they ebb and flow in terms of dynamic interest. I actually think right now, private infrastructure, private real estate is really kind of in the sun in terms of funding data centers and just the significant capital need there. Private credit really benefited from a period of time when the Fed was hiking rates, the ECB was hiking rates. We're no longer in that environment, really. And so I think there's a relative value trade-off. That being said, if you are an investor looking at credit, private credit, the one thing that has remained consistent is private credit is offering you additional spread compensation, not for higher risk, but for the illiquidity premia, basically reflecting the fact that these private credit lenders don't sell out of this exposure. I would say our conversations with institutional investors are actually looking for ways to deploy in this space. The one thing that's different, though, is they're looking to deploy in areas, for example, like distressed, special situations, and opportunistic lending, as opposed to the kind of senior direct lending, which had been, to your point, the focus for the past few years.
Does distress exist?
There for sure is dry powder on the sidelines across all of these strategies. I think what you're hitting on is a point that a lot of distressed investors have been waiting for a distress cycle really since 2022, right? Because
Yes.
there was a view that there would be an imminent recession in the U.S. and in Europe years ago. But I do think, kind of going back to John's point on software, if there's an issue in software, it's not going to be isolated to private credit, because actually what we didn't talk about is the broadly syndicated leveraged loans largest industry weight is also software. So if there's an issue with software, it's going to be an issue across multiple pockets of the credit market. In that sort of scenario, private credit likely steps in to deploy because they do have the patient capital, which is a competitive advantage. We've seen multiple periods where the broadly syndicated loan market kind of seizes and risk-off periods, doesn't operate like we wish it would, kind of pulls back from lending. That would be the opportunity, in our view, for private credit to step in. So I think it's just private credit's role in the financial ecosystem is largely intact in our view. It's just the mix shift of growth has pivoted more towards institutional, kind of more towards special situations, opportunistic, less in retail and less in direct lending.
Smart framing. Amanda, it's good to see you.
Thank you.
Thank you. Amanda Lynham there of Goldman Sachs. Remember that moment in the pandemic? Distressed investors got very excited. This was the moment. It was the moment. The Fed had other ideas. It was not the moment. We moved on very quickly.
It was a moment. It was about 6 hours. And if you wanted to get in on it, it wasn't going to be in the debt markets because there was no debt transacting because everybody was so excited about this moment to buy that nobody sold. And in the stock market, you saw a dip. And quickly, if you bought that dip, well, congratulations.
Crazy how things turned out. The fears people had and how things ultimately turned out.
This is, though, underpinning a lot of the bullishness. You're seeing this in credit and you're seeing this in equities. Nobody wants to miss the dip, so there hasn't been a dip.
Coming up on the programme, we'll catch up with Greg Daco of EY Parthenon on whether the Walsh Fed's first rate move could be a hike. Plus, Danny has your morning movers. AutoZone's third quarter sales falling short of estimates. That stock is down by 5% in early trading. 60 minutes away from the cash open, looking at a 4-day climb on the S&P 500, 4-day winning streak following an 8-week winning run on the S&P. On the Nasdaq this morning, higher by more than 1%. Queuing off this in the bond market, yields lower across the curve, particularly at the front end, and we'll spend some time on that, the prospect of rate hikes and all of that in just a moment. 2-year yields are down by 6 basis points, just north of 4%. Let's get you some single names, some morning movers with more. Danny Berger joins us. Hey, Danny.
Hey, John. AutoZone reporting earnings this morning, and they missed on their third quarter comparable sales. The executives over there specifically pointing out their Mexico and international sales that stayed more or less constant than they were the prior quarter, so shares down 5 1/3%. Also looking at the ADRs of BP this morning, losing a chair over serious concerns of his conduct, according to the company there. This is a company that's gone through, I believe, 4 CEOs and 3 chairs in the past 6 years. So a lot of churn in this particular chair. Alfred Manifold was only there since last July. Shares fall 5.6%. Finally, Micron to the upside. A lot of things happening here. Semi is rallying. Huawei coming out with new technology that maybe increases the use of chips. You also have the president specifically calling out Micron at a rally on Friday for all the spending and investment they're doing in the U.S. and UBS raising their price target to over $1,000 for Micron. Before, it was $500-something, so more than 200% price target increase for Micron. Those shares up about 7 3/4%, John.
Crazy, just absolutely crazy. Danny, thank you. These analysts just can't keep up, which is unusual. Usually it's, they're being aggressively bullish relative to where the stock is, but they don't seem to be able to keep up with the earnings story as some of these names.
Yeah, especially when it comes to semiconductors, given the fact that they can charge pretty much anything, and all of the companies that are buying them, namely hyperscalers, feel like it's an existential risk. How much do they increase their capex simply because the cost had increased by the likes of some of these semiconductors? Well, guess who's winning that money? It's the semiconductors, and that's what we saw in earnings.
It's rare to say analysts haven't been bullish enough, right? Because typically you bring up the A&R page on a Bloomberg terminal and it's just a sea of buys along most names.
Given that, I wonder if they're going to miss the turn. Given the fact that they are all going to be preconditioned by missing the upside, how much they are going to be preconditioned to miss the downside at some point, because you're going to have to imagine there's going to be pricing pressure unless we see true productivity start to filter into the rest of the market.
It's a good point. For the equity market right now, all-time highs close to those levels on the S&P 500. For the bond market, yields pulling back just a touch as the Federal Reserve Chair, Kevin Warsh, is pledging to modernize the central bank while defending its independence.
I will lead a reform-oriented Federal Reserve, learning from past successes and mistakes both.
I want Kevin to be totally independent. I want him to be independent and just do a great job.
Warsh facing increasing odds of higher for longer interest rates as investors ramp up bets the Fed stays on hold and maybe considers hiking. Michael McKee joins us now for more. Mike, things are building, and they're building going into that June rate decision.
Absolutely. Now, this is perhaps Kevin Warsh's first day in the office, you know, after that nice ceremony at the White House, take your family out to lunch, go to one of your houses for the long Memorial Day weekend. His term as Fed chair, 4 years now, but his term as governor, 14 years. So, John, maybe one of your children someday will be questioning whether or not Kevin Warsh is going to resign with a new chairman in place. His first job is clean up on aisle 2. The price stability mandate is the second in the list, and there is no price stability right now. So he's got to get to work right away on PCE inflation before they can even think about cutting interest rates. We will get more information on that today with the, not today, but with this week in terms of what's going on, because we get the PCE inflation numbers on Thursday. Consumer confidence today will be interesting. All-time low in Michigan last week. We'll see what the conference board comes up with. A lot of other secondary, tertiary indicators, but we do get some really interesting information towards the week's end. And then, you know, if you're Kevin Warsh, you're sitting there wondering where everybody is on your first day. A lot of Fed speak this week, nobody in town. Kashkari is in Tokyo today, Logan, Jefferson, and Goolsby tomorrow. Lisa Cook's out in Stanford, California. Williams and Musalem are in Reykjavik on Thursday. Tom Barkin, who's from Richmond, will be in Washington. He's the only one. Mary Daly speaking out in California, some more Reykjavik, New Jersey. And then on Sunday, Chris Waller is in Croatia. The chair's in his office, but nobody else is home. He may feel a little bit lonely this week as he gets to work trying to figure out ways to convince everybody to vote for those rate cuts and make the changes he wants.
We'll have a young Governor Ferro on that list in no time, 2040 maybe, 2040 something. Michael, thank you. Appreciate it. Never seen Michael McKee so downbeat about Fed speak before. Lots going on in Iceland, apparently.
Well, I mean, I understand why they would want to give a speech in Reykjavik. Highly recommend.
Sounded pretty good, though.
I mean,
Tokyo,
I was about to say,
Croatia,
sort of the world tour.
I
But,
mean,
you know,
yeah, Mike should have gotten on the list. I mean, that's why he's upset.
Probably the kind of thing that Chair Warsh is going to push back on. What are you doing in Iceland?
Talking about
Right.
U.S. monetary policy. I mean, honestly, the geysers are amazing. And truth be told, it's really beautiful.
It's a great trip.
Gorgeous, gorgeous scenery.
Should we go?
Sure, I think that we should.
Next time, let's get the interviews lined up. Let's do it.
We could talk about monetary policy.
We'll take Greg Daco with us of EY Parthenon. He's got this to say. Warsh faces a challenging backdrop. Our expectation remains that the Fed will stay on hold throughout the rest of the year, but we would not be surprised to hear some policymakers suggest a rate hike. Greg joins us now for more. Greg, we're getting closer, but as you know, this institution moves very slowly. What do you think the next step is at the June meeting?
I think the next step is to include a dual-sided statement that says that essentially rate hikes are on the table should inflation prove more persistent. And you're already starting to hear some policymakers voice that very theme, that narrative that should inflation prove more persistent than what has been expected, then they would consider a rate hike as a possibility to bring down inflation and at least prevent the risk of inflation becoming more entrenched.
It certainly feels like the centre of the committee is close to that, if not there already. Then we start to think about thresholds.
Yeah.
Give me an idea of what it would take to actually deliver that rate hike once you slip into a more neutral kind of forward guidance?
So our baseline right now is that inflation will surpass 4% on a PCE basis, and that we're going to see some core inflation pass through from these higher prices via food prices. That's not the core, but via higher food prices, but also transportation costs, production costs that will lead to higher core inflationary pressures. By the end of the year, we're still expecting core PCE to be around 3%. That would be a threshold that I think is very key to watch, because if inflation is indeed 1 percentage point above the 2% target that the Fed has, there is going to be much more noise around the necessity of a rate hike, especially if that trend is moving sideways and not moving back towards the target. Remember, when we were at the end of the tariff impulse, which was the case earlier this year, we were seeing inflation still moving towards the 2% target, but there were some core services metrics that were still moving sideways, and that was the hesitation for further easing of monetary policy. Policymakers wanted to see more movement towards 2%. If we are at the end of this year still around 3% when it comes to core inflation, that's going to be the point at which some policymakers will be voicing the need for tighter monetary policy.
Do you think that with hindsight, the 175 basis points of rate cuts that the Fed did over the past couple of years was too much?
No. I think the Fed was right to ease monetary policy because we had underlying inflation that was moving back towards the 2% target, and we saw growing downside risk when it came to the labor market. So the combo of the two goals moving in the right direction were essentially this notion that the Fed could have eased monetary policy. I was actually arguing a few months ago that we could have continued to ease monetary policy back towards 3%. The key narrative right now and the key new development is the fact that we have higher inflationary pressures coming from the Middle East conflict. And this is something that was not expected back in January, February. So it is a new narrative that we're currently facing, and policymakers have to adapt to that.
And so they should treat this as largely a shock, a transitory shock that essentially will sort of fizzle out as the conflict is resolved, at least according to the argument. You hear people like Bill Dudley saying there's something else here you've got to pay attention to, which is that maybe we are not at neutral, maybe we're not above neutral, maybe we're below neutral. And you're seeing other strategists and former Fed members saying the same thing based on what we're seeing with corporate earnings, based on what we're seeing with people still able to buy things even at higher prices. What's your pushback to that?
I think in general, when we're looking at the economy, we have this economy that is strong on the surface, but fragile in terms of the narrow breadth of growth. And that is really important to consider, because when you think about the inflationary pressures that are currently building, the risk is that we're seeing a layered environment of supply shocks, where supply shocks are hitting one after the other. And in that type of environment, there's a risk of more inflation persistence. And that is really testing the cost of growth, the price of growth, which is eroding economic momentum. And so in terms of the neutral rate and where we are relative to the neutral rate, I think we're still in a moderately restrictive monetary policy stance when it comes to the long run. But when it comes to the short run, because of all these supply shocks, we're increasingly at an environment where monetary policy is easier than it appears to be. And that is why the Fed, I think, should be considering potentially tightening monetary policy, or at least signaling the potential to tighten monetary policy should there be more inflation persistence.
Do you think we could see Fed Chair Walsh dissent? A chair dissent in his own meetings?
I think that's very possible. It's something that hasn't been done since the 1930s, but I think it's very possible because we have a greater fragmentation amongst policymakers. We have a large share of policymakers, a vast majority, per the FOMC minutes of the April meeting, a vast majority that considers rate tightening as a potential next move for the Fed. And in that environment where Kevin Warsh is indeed supportive of easier monetary policy because he's expecting AI investment to deliver strong productivity growth and ease inflationary pressures, he believes the Fed should be accommodative today. That's not what most policymakers, especially regional Fed policymakers and some governors, are thinking about. They're much more focused on the today, on the here and now of inflation being above the 2% target and moving in the wrong direction. I think the movement is very important.
I've got to ask you this. If you did see Chair Walsh dissent against the bulk of the committee, how would Governor Powell vote?
I think he would vote with his mind and with his heart.
You don't think he'd vote alongside Chair Walsh just to keep a low profile?
Perhaps, but the reality is that Powell is much more concerned about the institutional credibility of the Fed. And in that regard, he's going to be very much focused on the two objectives, inflation and maximum employment. And if there are indications that inflation is moving further away from the 2% target, while the employment side of the mandate is still relatively stable, even if in appearance, he would actually consider tightening monetary policy or at least moving towards a more hawkish bias. So I don't think he would necessarily just follow Kevin Warsh in every decision to not make any noise. He's going to be voting as to what he believes is in the best interest of the U.S. economy.
Looks like he'll be making noise regardless whether he likes it or not. Greg, thank you. Appreciate it. Greg Daco there of EY Parthenon. Can you imagine if it plays out in that particular fashion, what that would look like? What kind of signal would that send?
You know, if everybody voted to hike rates and we did not get that from Chair Warsh, that I think alone would be a pretty big signal. And then if you had, of course, this question of Governor Powell voting alongside the rest of the committee, then the conversation will be Kevin Warsh lost control over the Fed. Kevin Warsh is a Fed chair in name only, but not in practice.
Which is why dissenting, if the chairman chooses to dissent, the optics of that would just be atrocious for the chairman, by the way.
Well, not just that, but also because Kevin Warsh was one of the most hawkish members of the Fed board when he was back on it back in the 2000s. So you start to wonder, who would this person be? I mean, again, will the real Kevin Warsh please stand up?
Of course, a lot of speculation here. We've got no idea. I imagine June's going to be very boring after all of this. Just be very boring.
So?
Slip into neutral.
Yeah, I don't think so.
Keep the news conference really short.
You think so?
5 questions.
Honestly, the way that he does that will be analyzed, scrutinized.
Is he thinking about capping questions?
No, I'm just saying, you know.
I got nervous
make
for a
it
second.
super short.
Yeah, I don't think so.
Who says he has to take like 20 questions in the news conference and the thing has to last 60 minutes? Who says? He can keep it short if he wants to.
Stop.
Yeah, he could change it.
Don't give him ideas.
All right.
Stop.
Yeah, but
I'm sure he's got his own ideas on the matter. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Yahara has more. Hey, Yahara.
Hi, John. The head of the World Health Organization is visiting the Ebola-hit Democratic Republic of Congo today as fears grow over a wider regional outbreak. The number of confirmed deaths in the country has now topped 200. China is restricting overseas travel for top AI professionals at firms such as Alibaba and DeepSeek. The move escalates efforts to safeguard strategic technology and close the gap with the U.S. on artificial intelligence. And we are seeing BP shares trading lower in London after the company removed Chairman Albert Manifold effective immediately. BP says the decision was tied to serious concerns over governance, oversight, and conduct, but the company did not provide specific details. That's your Bloomberg brief. John.
So much churn at that company. So much churn. I think that's rattled a lot of investors. Yahara, thank you. Up next on the programme, we'll set you up for the day ahead. Plus, we'll catch up with Richard Bernstein of Janus Henderson Investors on why he's sticking with a boring portfolio. Not quite the best tease, but he'll tell you why in a moment. From New York City, you're watching Bloomberg TV.
The case for cutting rates now is actually very, very weak. We've been above the Fed's inflation target for more than 5 years, and there is a risk that inflation expectations do finally become unanchored. The Fed is concerned that they're starting to lose credibility because they haven't been able to get inflation back down to 2%.
Bill Dudley, former New York Fed president, just hit pause just for a moment. Took 3 hours. Took 3 hours, converted Bramo. OK, no longer supporting the new Ferrari. What's the position now?
I think that the orange one looks okay. Look, you made me look at one versus the other.
The Ferrari Amalfi.
The Ferrari Amalfi versus
a real Ferrari.
You know, one of these, and it just
the epitome of design.
It doesn't. It
she just wants to be contrarian.
A little bit like a
but
car
even she
that
can't hold this line.
A kid would have just pull back. It looks very basic. But it might be really good for Johnny Ives, right? Because it sort of is reminiscent of the Apple designs, but not necessarily Ferrari's designs, but it might have a great engine.
I remember getting to a traffic stop in Sao Paulo. Taxi pulls up, stops. Car to the right of me pulls up to the side. Father gets out with his child, walks towards the showroom, holding his hand just to look through the window at the Ferraris. That's the pull that brand has, the epitome of design, aspiration, ambition, even for people who wouldn't be able to dream of ever buying one. That's what a Ferrari should be. That thing that Ives has designed as a standalone vehicle, judge it as a standalone vehicle. As a Ferrari, I'm sorry, but the bar is like up here and it falls way short of deserving that badge.
If people are just joining now, earlier when I was trying to defend this car, John said that he put me in a bucket with cut spaghetti as well as cappuccinos after lunch, which gives you a sense,
And ketchup on pizza.
I will not put that in there because it's disgusting.
And then called the Luce de Luce. So there we go. It's been the last 3 hours. As we count you down to the opening bell, here's your trading diary. The week ahead, better than this. 10 a.m. Eastern Time, Conference Board consumer confidence in focus after UMich was rock bottom on Friday. Looking ahead to Salesforce earnings on Wednesday, Thursday, core PCE, durable goods, and another round of claims, plus Costco earnings. Look out for Costco and a couple of other retailers, I believe Best Buy, in the mix as well. Stocks extended gains this morning ahead of the opening bell. Richard Bernstein of Janus Henderson Investors writing, it seems clear that we're in some sort of highly speculative environment. We are sticking with our theme of boring is beautiful. Richard joins us now for more. Richard, welcome back to the programme. Congratulations, by the way, on the acquisition to Janus as well. Welcome, sir.
Thank you.
Let's talk about boring is beautiful. What is boring in 2026? What is that?
So, John, what's boring is basically almost everything out there that people don't want to look at. I mean, I would argue that the range of potential investments is maybe historically broad, but people have no interest in this broad kind of normal capital formation investing. Everybody's speculating, and the quote you had from me was referring to that people are having trouble differentiating between the financial markets and the prediction markets. And that's ridiculous. That shows how speculative an environment we're in.
You talk about short duration investments and focusing on just the higher quality within fixed income, which is notable right now, given the fact that a lot of people are talking about inflation as the big risk. Inflation is not boring. It tends to wreak havoc through a whole series of stocks and pick winners and losers. How do you deal with the inflation risk? How much of that is underpinning some of your boring thesis?
Right. So, Lisa, I think that people have focused too much on the near-term cyclical inflation issues. Even your previous guest talked about the war a little bit. I think people are still missing the secular backdrop, which is very inflationary relative to history. I don't mean like there's going to be 8% inflation, but I would argue vehemently that the Fed's 2% inflation target is very antiquated, or they've got a lot of inflation fighting to do. They have a weird choice they got to do here. And the reason why is simply deglobalization. And deglobalization is inherently inflationary because we're reducing competition. And as you reduce competition, you get upward pressure on prices. So you want short duration, whether it's short duration fixed income or short duration equities, because as inflation pipes up, you need more cash flow up front to meet your spending needs. People have forgotten about that in such an extended period of disinflation. So we think that's very, very important, is those near-term cash flows.
Does that make stocks better than bonds? Because a lot of people have been talking about stocks as an inflation hedge. Do you buy that narrative?
So I think dividend-paying stocks, yes, I would agree that dividend-paying stocks are very attractive. I'm not sure long-duration growth stocks are all that attractive in a higher inflation environment. And in the fixed income world, I hate to say this is like heresy to say what I'm about to say, but during inflationary periods, cash does really well. Now, does that mean you have to go to cash? No, but there's lots of things, what I like to call cash plus, which are, short-term, high quality, whether that's treasuries, mortgages, securitized. There's this whole universe of very short-term cash plus type investments.
Richard, I want to ask you what you think of prediction markets, because you talk about it on your note. How speculative is the environment when you say basically, and you're correct, you sometimes can't tell the difference between what's going on in prediction markets and the stock market?
Right. So, Annmarie, I think that people have totally lost the point of what the financial markets are all about. The financial markets serve an economic purpose to build capital formation. Right? Companies can raise capital. They can then expand plant and equipment. They can expand employment, but it's real investment in the economy. So the financial markets are there to spur real investment in the economy. The prediction markets have no economic value added whatsoever, right? They're basically saying, oh, something happened, that's good, and you win. So I don't quite understand how one could get this one, that the Knicks are going to beat the Cavs, right? I guess that paid off pretty well. But that has some economic value in the economy.
When there are binary things, though, that people are betting on, is there information in where that money's going, Richard, to apply to how you'd approach equity markets?
Well, I think there's an information content, perhaps. I mean, I think that there was certainly some academic studies on limited prediction markets and what would happen, and do they tell more than is there information content in those prediction markets? I think the answer to that from an academic perspective was certainly yes. But now we have so many prediction markets, and there's also questions, I think legitimate questions, about whether they're fair or not. Does it really give you the information content that people believe? I'm not so sure about that.
Richard, appreciate your take. As always, we'll see you in person next time. Thank you, sir. Richard Bernstein there, now of Janus Henderson Investors, on prediction markets at the end there, and the shortfalls when thinking about financial markets.
Yeah, there are a lot of people who are saying that potentially they're increasingly more detrimental than they are beneficial, in part because it also is training a new generation of investors to essentially just gamble. And what we see in day-to-day market activity is becoming more like gambling. Are they going to open? Are they going to close? Do we even know what that means? Doesn't matter. Open, close, open, close. Is that really going to ignite the interest of a lot of portfolio managers that have 3-4 month horizons? Probably not. And that's what you hear every morning.
Also, I think what we've seen, at least in Washington, D.C., is a lot of concern. I mean, the White House even had to send out a note reminding people not to make sure they're using some information that they're hearing in the likes of the prediction markets. Think harder to track down who potentially is going on the prediction markets with information that is not known to the public.
Who's got an edge and who doesn't right now? We're done this morning. That was fun, wasn't it?
That was fun.
We're done with Ferrari for the week, right?
No.
No, we are.
Absolutely.
No more. Not tomorrow. We're done.
No, we're
completely
done. We're absolutely
moving
done. Oh, tomorrow she'll be clutching her Knicks mug again. That was literally through the whole show. Occasionally, we just
just to show everybody.
Just so you guys know, though,
during her commentary, she would just sort of
since the show started, because I keep refreshing, tickets have gone up.
I'm glad you're focused.
What's the get-in price now?
It's closer to $4K now, and you're talking nosebleeds. Again, anyone out there?
We don't accept tickets, but maybe we do.
Yeah,
kind of, sort of. All right. From New York City this morning, good morning. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance, and we'll see you tomorrow morning.